The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled The Future of Digital Assets, Providing Clarity for the Digital Asset Ecosystem. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I'll now recognize myself for 4 minutes to give myself an opening statement. Nearly 15 years since the Bitcoin white paper, an idea has become the new internet architecture, with ownership, digital identity, and value storage native to technology. Digital assets now are no longer a new technology. They're used all over the world. And America has always led technology invention, and if not invention, implementation. And today we're at risk of falling behind competitors around the globe. This hearing has been years in the making, bipartisan years in the making. Over the past several months, this committee has engaged in an unprecedented joint effort with our colleagues on the Agriculture Committee. Earlier this month, Chairman Thompson and I, along with Subcommittee Chairs French Hill and Dusty Johnson, released a discussion draft that would close the gaps between our securities and commodities laws and provide much-needed clarity for digital assets. We adhere to the time-tested principle of same risk, same regulation, while modernizing our regulatory framework to better match this innovative technology. In fact, requirements set out in the draft bill are much more onerous than the requirements for traditional financial intermediaries. As I've said, in all of our markups, I have an open door. This should be a bipartisan process, and I intend it to be. So please share your input. This is a draft bill. There's plenty of time for us, members, to find common ground on how we legislate here. But be advised, I intend for this committee to mark up some form of this legislation when we return from the July 4th recess. Let's start with where I know we all agree: consumer protection. The draft bill would require trading platforms to comply with strict requirements regarding the segregation of customer assets, similar to most traditional intermediaries. We also address how digital asset issuers raise capital for their projects. The U.S. has the deepest and most liquid capital markets in the world. We intend to keep that. We want to keep that strategic advantage here in the United States to the best of our ability. We know informative disclosures are critical to helping investors make informed decisions. By making disclosures fit for purpose, the draft bill will ensure issuers provide users with necessary information, including the number of tokens in circulation, the concentration of assets held by affiliates, and much, much more. Additionally, we enhance the SEC's ability to detect and punish fraudulent actors and activity. Today, traditional financial intermediaries are registered with the federal regulator. Digital asset trading platforms should be no different. The draft legislation will establish requirements for digital asset trading platforms, ensuring Americans and their assets are protected. The draft bill will provide a workable path for trading platforms to register with the SEC and/or the CFTC. It provides clarity to those assets that are offered as part of an investment contract and therefore a security. And I would submit the central part of this bill is this: a workable time frame and a workable time period for assets started as part of an investment contract to transition to a digital commodity, if the network is functional and decentralized. I think that is the central piece of this legislation that our discussion should be focused on. So let me close with this. We're at a critical moment for American dynamism. We can choose the side of financial freedom, innovation, inclusion, and American competitiveness, and important consumer protections at the same time. Or we can let this moment pass us by and surrender our leadership of the global financial system to other countries. I hope we'll choose the former. I yield back. I'll now recognize the ranking member of the full committee, who, as chair last Congress, started this long arc for stablecoin legislation and the discussion that we're centering on today on this market structure bill. With that, I'll recognize the ranking member, Ms. Waters, for 4 minutes for her opening statement.
Thank you very much, Mr. Chairman. Good afternoon. Last week, Republicans posted a bill that would rewrite our nation's securities and commodities laws. Committee Democrats are taking a serious and thoughtful look at this piece of legislation. However, the bill is 160 pages long, highly complex, and was only made public about a week ago. Any bill would so dramatically overhaul our nation's capital markets must be worked on collaboratively with the minority. We also need the analysis and views of our independent regulators, the administration, and the stakeholders on the implications of this legislation. With that said, I have some initial concerns I'd like to discuss today. For starters, I'm particularly worried that the Republican bill would allow crypto firms that are currently being sued for violating our securities laws to continue doing business through provisional registration. We witnessed last year when disgraced FTX CEO Sam Bankman-Fried defrauded millions of customers, and now the SEC is taking actions against firms like Binance and other firms for potentially similar behavior. The bill appears to halt any enforcement actions by the SEC against crypto firms, even when they have committed fraud. This provisional registration could reward bad actors with a get-out-of-jail-free card and allow them to continue harming consumers and investors. We also know that FTX illegally commingled customers' funds to make undisclosed investments and to trade against its own customers. The SEC has ramped up its enforcement against other crypto firms for the same misconduct. Broker-dealers today are and have been for decades prohibited from commingling customer assets. So I wonder why Republicans would legitimize this illegal practice for crypto firms and allow customer funds to be put at risk. Another point I'd like to raise is that 3 crypto firms recently received approval to operate legitimately under our securities laws. Franklin Templeton received approval to offer a money market fund on the blockchain. OTC Markets received approval to trade crypto securities, and Prometheum, of which the CEO is our witness today, received approval to custody and trade crypto assets. As SEC Chair Gensler has repeatedly said, the door is always open for crypto companies to register with the SEC. Despite the claims of some in the industry, our securities laws, which have worked for every other industry for 90 years, can also work for crypto firms. Turning to the stablecoin bill that was also noticed for this hearing, I'm encouraged by the legislative progress that's being made. That said, while Republicans have heeded a few of our concerns, there are still major red flags, including the bill's lack of diversity and inclusion protections, weak consumer protections, and wholly insufficient oversight by the Fed of state-chartered stablecoin issues. So I look forward to returning to the negotiating table to finish what we started last Congress. I do believe that Mr. McHenry and I have gotten a long way in dealing with stable coins, and I'm sorry that it got interrupted somehow, but I'm looking forward to getting back and negotiating and see if we can move stable coins forward.
I look forward to those continued conversations. And I appreciate you starting this long discussion on digital assets under your leadership. And my intention is to utilize those conversations we've had and come to some reasonable conclusion that we both can support. And I want to thank the former chair and the current ranking member for that. The chair now recognizes as chairman of the Subcommittee on Digital Assets, Financial Technology, and Inclusion, the gentleman from Arkansas, Mr. Hill, for 1 minute for an opening statement.
I thank the chairman. Good afternoon. Thank you all for joining us in our panel, particularly for the 6th hearing that we've had in our full committee hearing on digital assets. For months, the Digital Assets Subcommittees on House Financial Services and the Agriculture Committees have been working on legislation to establish a functional regulatory framework with strong consumer protections. The 2 proposals noticed at the hearing are the result of that good work. Importantly, the market structure bill would prevent another FTX from happening by ensuring customer assets are protected, by providing robust guardrails to mitigate conflicts of interest, and by establishing clear oversight and supervisory authority for federal regulators to ensure market participants like dealers, exchanges, and custodians are compliant with our securities and related commodity laws. Like then Chairwoman Waters said, in November after FTX, we need a legislative action to ensure that digital asset entities cannot operate in the shadows, and that's exactly what we've done. I want to be clear, we want feedback from our members and look forward to that during the course of the hearing today, and I yield back to the chair.
The chair now recognizes the ranking member of the Subcommittee on Digital Assets, Financial Technology, and Inclusion, the gentleman from Massachusetts, Mr. Lynch, for 1 minute.
Thank you, Mr. Chairman and Ranking Member. I must say I continue to have grave concerns with key elements of this bill, both these bills under consideration, which I believe will serve to fundamentally undermine our broader financial system. By creating a whole new regulatory carve-out dedicated to digital assets, these bills create a loophole that allow any non-bank security issuer to digitize or tokenize its products so it will be able to avoid compliance with existing investor protections and financial stability regulations. I'm also deeply concerned about the new roles defined for the SEC and the CFTC. These bills are both targeted at greatly reducing the SEC's authority and would hinder its ability to conduct adequate enforcement. Our financial system, which is the envy of the world and the source of U.S. primacy in global finance, is in its essence built on trust and the investor protections afforded by the rule of law. I would urge my colleagues to take a critical view of these bills and consider how the insecurity and volatility that these changes will inject into our traditional financial system and which will endanger the trust and confidence in that system. Thank you, and I yield back.
Gentleman yields back. Today, we welcome the testimony of a great panel. Jeremy Allaire. Mr. Allaire is the co-founder, chairman, and CEO of Circle. Coy Garrison. Mr. Garrison is a partner at Steptoe & Johnson and former counsel to SEC Commissioner Hester Peirce. Thomas Sexton III. Mr. Sexton is the president and CEO of the National Futures Association. Emin Sarir is the founder and CEO of, Dr. Sarir is founder and CEO of Ava Labs. Finally, Aaron Kaplan. Mr. Kaplan is the founder and co-CEO of Prometheum Incorporated. We thank each of you for taking your time here. Each of you will be recognized for 5 minutes to give an oral presentation or testimony. Without objection, your written statements will be made part of the record. Mr. Allaire, you're recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and members of the committee, it's an honor to be here today. I'm Jeremy Allaire, Chairman and CEO of Circle. I co-founded Circle 10 years ago with the vision that digital currency would transform how value was exchanged. 5 years ago, we launched USDC. Today, USDC has grown to become one of the largest dollar digital currencies in the world. USDC powers tens of thousands of applications and has handled over $10 trillion in transactions. The core of Circle's day-to-day mission is expanding the role of the dollar on the internet. The demand for safe and secure dollars on the internet is real and growing. Stablecoins and blockchain networks will likely become strategic infrastructure for the future of the internet. It's a profound moment for the dollar in the world today. Currency competition is real and is increasingly defined by technological competition. No nation understands this better than China, with its own state-controlled digital yuan, complete with embedded surveillance. The steps the US government takes now will have a significant impact on dollar competitiveness in the decades that follow. Failing to take the appropriate steps could have devastating consequences for America. As a nation, we need to ensure that the dollar is the most competitive currency on the internet. There also needs to be universal access to the safest and most secure digital dollars possible. These digital dollars must be backed by the safest assets. The world must have the safety and assurance needed to exchange value without fears of bank runs. Access and safety are cornerstones of keeping the dollar competitive. But at the heart of dollar competitiveness must be technological superiority. That means unleashing the innovation made possible by software, the internet, and free market competition. We're here today to consider and discuss proposed stablecoin legislation. I appreciate the substantial and bipartisan work you've all done. Delivering a stablecoin bill to President Biden's desk should be a national priority. Already, other major nations are enacting laws to regulate the use of dollar stablecoins. Rather than let other countries define our future, the United States needs to lead the development of global rules that will determine how our currency moves around the world. The broad parameters of this bill are strong, providing for robust supervision, strict reserve requirements, redemption, custody, and reporting requirements that protect consumers. The bill also provides roles for both state and federal regulators and supports both bank and non-bank issuers. At the same time, there are several issues on which I'd like to comment. The first is the respective roles state and federal banking regulators should play. We need to ensure an important and continuing role for states in the growth of well-regulated stablecoin adoption. To start, we need nationally established standards that set a high bar for all issuers and that can be enforced by federal regulators where appropriate. A second issue is related to reserves. Circle believes issuers should only hold reserves that are even safer than for banks, where fractional reserves put the safety of money used for payments at risk. A simple solution would be to afford issuers limited rights to basic Fed services, facilitating more timely redemptions, protecting consumers and financial stability, and without needing to provide access to the discount window. Finally, are questions around custody and safekeeping. The harsh lessons of 2022 teach us that we need stronger protections around the custody of digital assets. A common ground solution would be to require that any stablecoin intermediary be required to hold them with either a state or federally chartered qualified custodian. Back in the late 90s and early 2000s, we went through an intense hype cycle and then a dramatic crash in the development of the web. There were total losses, scams, and frauds. A combination of proactive policy and private sector development led to a period that made America the uncontested technology leader. We're in a similar moment today, but we don't have the luxury of time. The tech capability gap that existed then has now been closed by China. The dollar is at a crossroads, and currency competition is now technology competition. I ask all of you, as members of Congress, to consider this moment. Ask what value system we want to enshrine in law, and how do we safely and deliberately unleash the creative forces of US-led technology innovation. Thank you again for the opportunity to be here today. I'd be happy to answer any questions you may have.
Thank you. Mr. Garrison, you're now recognized for 5 minutes.
Thank you, Chairman McHenry, Ranking Member Waters, and members of this committee for inviting me here today. My name is Coy Garrison. I'm a partner at Steptoe & Johnson, where I advise participants across the digital asset industry on securities law compliance. Prior to 1 year ago, I was an attorney at the SEC, where I had the honor of serving as counsel to Commissioner Hester Peirce. I'm testifying today on my own behalf, and not on behalf of my firm or any client of my firm. My message to you today is simple. Congress must act to bring sensible regulation to the digital asset industry. Today's discussion draft is thoughtful and measured. It would create a workable regulatory framework for the industry with much-needed investor protections. Before highlighting the positive aspects of the draft, I'd like to discuss why congressional action is needed. First, the application of securities laws to digital assets is not always clear. Sweeping statements that nearly all digital assets are securities or are not securities ignore the complexity of the analysis and distract from finding a workable solution to the issues at hand. Congress defined security in 1933 by referencing more than 30 instruments. Unsurprisingly, digital assets are not included in this list. Generally, the question becomes whether a digital asset is sold pursuant to an investment contract. Under the Howey case, an investment contract is a contract, transaction, or scheme where you have an investment of money in a common enterprise that leads to a reasonable expectation of profit from the efforts of others. The application of this test is not always straightforward. Indeed, the SEC staff issued guidance on the subject in 2019, and it identified over 60 factors to consider. Additionally, even if a digital asset is sold pursuant to an investment contract, the digital asset itself is not the security. Rather, it's the digital asset plus the promises of the third party that constitute the transaction, the contract, or the scheme that is the security. Further, as of today, there simply is no case law addressing the application of the Howey test to a secondary market transaction in an investment contract. And if that is not enough, adding to the complexity, the SEC staff has taken the position that a digital asset that at one point in time may represent a security may over time no longer represent the security if the network becomes sufficiently decentralized. There is no clear guidance on how this happens. Second, congressional action is needed because the SEC has refused to create a workable regulatory framework. Digital asset trading platforms cannot register under existing rules because those rules are not designed with the realities of how digital assets trade or operate. Existing equity market structure rules do not contemplate concepts made possible, such as instantaneous settlement, the potential for trading of securities and non-securities on the same platform, and the lack of a need for intermediaries for various functions. The SEC has shown little interest in considering changes to existing rules. The Commission is instead relying on enforcement actions, some of which will take years of litigation and appeals to result in any binding judicial precedent. Absent a congressional directive to the SEC to engage in rulemaking, the status quo will likely persist for the foreseeable future. Third, congressional action is needed because the lack of regulation harms investors, responsible industry participants, and the U.S. economy. The status quo fails to protect people that are trading digital assets. While there are a number of responsible platforms appropriately safeguarding customer assets and monitoring against fraud and manipulation, some platforms have notoriously put their customers' assets at dramatic risk and cause significant loss. While enforcement actions are important tools to hold wrongdoers accountable, they simply cannot replace sensible market regulation that can help deter, identify, and mitigate wrongdoing. Fortunately, the market structure draft provides a foundation for a responsible regulatory framework and addresses a number of the regulatory uncertainties I've just highlighted. the bill forces the SEC to turn its focus to producing a more workable regulatory regime and to also responsibly divide responsibility of the digital asset spot markets between the SEC and the CFTC. First, the bill would create a new exemption where a digital asset can be sold pursuant to an investment contract to non-accredited investors with important investor protections in place. Second, the bill would require the SEC to modernize its secondary trading rules to permit the trading of digital assets. Third, the bill would also provide the first framework for how a network can become decentralized, and it creates a formal process to transfer regulatory responsibility from the SEC to the CFTC. Fourth, the bill gives the CFTC authority to regulate the spot markets and digital asset commodities in a responsible manner. In conclusion, the discussion draft would provide regulatory certainty that is needed to ensure that the digital asset industry can innovate and grow the U.S. economy. Thank you for your tremendous work on this important legislation, and I look forward to your questions.
Thank you. And I recommend to the panel you bring the microphones closer. This is the best technology that we can bring to you from the 1940s. Mr. Sexton, you're now recognized.
Thank you, Chairman McHenry, Ranking Member Waters, and committee members for inviting National Futures Association to appear before you today. My name is Tom Sexton, and I am the President and CEO of NFA. We applaud this committee's and the House Committee on Agriculture's joint work. The committee's June 2nd discussion draft contains the critical customer protections that Congress should adopt as it moves forward with developing a statutory framework for spot digital asset commodities. Congress in 1974 authorized the creation of registered futures associations. NFA is the only one. Congress and the CFTC in 1982 gave us the responsibility to regulate firms engaging in exchange-traded derivatives. Over the years, Congress expanded the CFTC's jurisdiction, and we were entrusted with additional responsibilities over spot retail forex and swaps. NFA is solely a regulator, and we partner closely with the CFTC to perform our work. We currently have approximately 3,000 global member firms that the CFTC requires to be members of NFA and 42,000 individual associate members. We have approximately 520 employees, and our budget is approximately $140 million, all paid for by the industry. Our 7 primary areas of responsibility are described in my written testimony. Let me highlight 2. First, we monitor and examine our members for compliance with NFA's rules. One key oversight area relates to customer funds. Futures Commission merchants, by rule, must hold these funds in segregated accounts at qualified depositories, which are separate from the FCM's proprietary and operational funds. Each day, we receive reports directly from these depositories holding these funds to ensure that an FCM holds sufficient money to cover the amount owed to customers. Second, we investigate possible rule violations and vigorously enforce our rules. Our enforcement efforts are coordinated closely with the CFTC and, if necessary, law enforcement. Over the past 10 years, nearly 25 individuals have gone to prison due to criminal misconduct, many involving retail customers initially investigated by NFA. My written testimony describes our strong track record in 2 areas and how we partnered with the CFTC to protect retail customers and prosecute retail trading abuses and fraud. In both cases, our enforcement actions and customer-filed arbitrations dropped precipitously due to our actions. Let me highlight how we tackle customer abuses in the spot retail forex market. Forex dealers appear to function similar to firms that offer digital asset commodities. They solicit retail customers, accept customer funds, operate an electronic trading platform, and may take the other side of the trade with customers. In 2008, Congress gave the CFTC anti-fraud and regulatory jurisdiction over spot retail forex transactions and their dealers. Congress prudently placed a fence around these spot forex transactions within the Commodity Exchange Act and created a separate registration category for forex dealers, who Congress required to be members of an RFA. Today, NFA and the CFTC impose extensive customer protection rules upon these dealers. Let me now turn to our involvement with spot digital asset commodities. Member firms engaging in spot digital asset commodities are already within our doors. NFA has proactively acted to oversee members engaged in this activity. In 2018, We required members to provide enhanced disclosure requirements and an investor advisory to customers. More recently, we filled a jurisdictional hole by adopting a rule that imposes anti-fraud and supervision requirements on members engaged in this activity. NFA's rule currently covers Bitcoin and Ether. Retail customers have suffered significant monetary harm in schemes involving digital asset commodities and deserve protection. Only Congress can create a federal registration and a regulatory regime. Therefore, we encourage you to provide the CFTC with regulatory authority to complement its current anti-fraud authority over spot digital asset commodities. Only then can the CFTC adopt the discussion draft's critical customer protections, including those relating to customer assets, business conduct and disclosures, minimum capital requirements, and trade practices. Finally, I want to voice our strong support for the critical role as provided in the discussion draft that an RFA should play to partner with the CFTC to regulate this area. NFA has always been willing to take on the additional responsibilities entrusted to it by Congress and the CFTC, and we will do so again to the extent requested. Thank you, and I'm happy to take any questions.
Thank you. Now, Dr. Sarir, you're recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and members of the committee, it's an honor to be here with you today. I thank you for the opportunity to appear before you as a computer scientist to discuss blockchain technology, its innovative uses, why it's impactful to our economy, and why it must thrive in the United States. I'm the founder and CEO of Ava Labs, a blockchain software company headquartered in Brooklyn with the mission to digitize the world's assets. We have developed some of the most significant recent technological innovations in blockchain, including the biggest breakthrough in consensus protocols since Bitcoin. I was previously a professor of computer science at Cornell University for almost 20 years. I consulted with various US government agencies and made fundamental contributions to distributed systems, operating systems, and networking. I'm also currently a member of the CFTC's Technology Advisory Committee. We are living through a period of unprecedented technological progress and transformation. Computers initially set this trend in motion with isolated mainframes and personal computers that lacked network connectivity. The emergence of the internet marked a pivotal shift from isolated local computing to global-scale computing using what we call client-server architectures. This new paradigm, which enabled us to connect to services operated by others, gave rise to systems that cater to the entire world, created millions of jobs, and solidified the United States' position as a global economic leader. Blockchains represent the next phase of networked computer systems. Whereas client-server systems rely on point-to-point communication, blockchains facilitate many-to-many communication, allowing multiple computers to collaborate, achieve consensus, act in unison, and share services under adverse network conditions. This enables the development of unique digital assets, more efficient financial services, programmable assets in computer games, and digital identity solutions, among many other innovative applications. My full written testimony contains examples of blockchain applications that tangibly improve people's lives. The implications of this breakthrough are far-reaching because blockchain and the digital uniqueness it creates allow us to redefine trust, ownership, commerce, recreation, and communications, ultimately transforming how we interact with digital systems and each other. The determination of the regulatory regime for blockchains must start and end with the functionality and features of the digital assets and not the technology used to create them. At Ava Labs, we call this a sensible token classification. Blockchains have the ability to build into their technological fabric any set of rules that are then automatically applied to all relevant transactions. This enables us to build efficient, self-enforcing networks. For example, the Avalanche software allows anyone to build custom blockchains with creator-defined rule sets, including financial regulations. Other blockchains are working on their own equivalent solutions. Now, let me be clear on 3 key points. First, decentralized networks are a desirable goal for many reasons that have nothing to do with regulations governing use cases. In fact, they're more resilient, secure, auditable, and available than traditional systems. Blockchain builders did not set out to develop technology to evade laws. We set out to solve hard computer science problems. Second, tokenization also was not created to evade laws. It's the natural product of blockchains and an improvement over traditional systems, just like computer databases were an improvement over paper filing cabinets. Third, as we enter this new era, we must support this revolutionary technology. By doing so, we can ensure that the United States remains at the forefront of innovation, propelling the next generation of internet technologies and ushering in great economic growth. The US won the first wave of internet revolution precisely because it enabled the freedom to innovate responsibly. The United States must follow the same path of enabling free but responsible growth of blockchain technology through sensible regulation of blockchain applications and tokens based on implementation and use case. Otherwise, there are two critical paths of failure for any regulatory framework. First, the blockchain platforms themselves should not become regulated at the protocol layer. This would be the equivalent of regulating internet services in internet routers, which would have doomed the vibrant internet we have today. Second, the tokens and smart contracts created with blockchains should not be lumped into homogeneous and incompatible categories. This would be the equivalent of regulating a social media application the same way we regulate a consumer healthcare application. Instead, tokens and smart contracts must be regulated based on their function and features. Finally, it's essential to remember that just as good people are committed to public service, there are also good people committed to building technologies to improve lives. By working together, we can lay the groundwork for trustworthy, efficient, and self-enforcing systems that serve as the foundation for our modern economy. I thank the committee for the opportunity and look forward to your questions.
Thank you, Dr. Sarir. Now, Mr. Kaplan, you're recognized for 5 minutes.
Committee Chairman McHenry, Ranking Member Waters, and esteemed members of the committee. Thank you for the opportunity to testify at today's hearing on the future of digital assets, providing clarity for the digital asset ecosystem. My name is Aaron Kaplan, and I am the founder and co-CEO of Prometheum. As an attorney, my background is in securities laws. Since 2013, I have dedicated my career to the application of distributed ledger technology to the securities industry and the related regulatory issues. Prometheum and its subsidiaries are building a public market.
Mr. Kaplan, if you'd pull your mic closer, it'd be helpful.
Prometheum and its subsidiaries are building a public market and custodial infrastructure for digital asset securities pursuant to the federal securities laws. Prometheum has developed proprietary technology in the United States, integrating the requirements and investor protections of securities regulation and efficiencies of distributed ledger technology. Prometheum subsidiaries are Securities and Exchange Commission registered broker-dealers and FINRA members. Prometheum ATS is an SEC-registered alternative trading system that matches orders for buyers and sellers of digital asset securities under the federal securities laws. Prometheum Capital was recently approved as the first special purpose broker-dealer, meaning it is the first SEC-registered custodian for digital asset securities under the federal securities laws. By operating under the SEC's established regulatory frameworks through registered entities overseen by the SEC and FINRA, Prometheum provides Americans participating in the crypto and Web3 space with the investor protections of the federal securities laws. Through this, Prometheum is developing a fair and orderly market, ensuring customers' assets are properly segregated, secured, and custodied. In the vast majority of cases, crypto is a financial instrument offered to the public as an investment. Intermediaries are required to be regulated by the SEC based on the services they provide to the public. Properly regulating crypto trading, clearing, settlement, and custody under the securities laws provides a proven mechanism through which to allow and encourage responsible participation and innovation, while at the same time ensuring that investors are protected. There has been much discussion lately about the need for greater regulatory clarity for digital assets. The essential point at hand is not about more or less regulation or even new regulation, but rather the application of the existing regulatory frameworks to digital assets. The federal securities laws have been tried and tested for almost 90 years and have allowed the United States to establish the world's most trusted and advanced financial markets. The SEC is by far the most capable financial market regulatory agency in the world. The SEC relies on FINRA, a self-regulatory organization whose mission is market integrity and investor protection, to regulate the securities markets. Together, the SEC and FINRA employ approximately 8,000 employees to oversee these vital securities functions. Put simply, the federal securities laws and oversight from the SEC and FINRA have proven to be the most effective system to protect investors, operate fair and orderly markets, and protect customers' funds and assets. As early as July 2017, the SEC put the industry on notice in the Dow report, stating that digital assets and related financial services could and likely did implicate the federal securities laws. Subsequently, The SEC created a marketplace framework with the release of the 4-step process on July 8, 2019, and the 3-step process on September 25, 2020. Thereafter, the SEC created the framework for the clearance, settlement, and custody of digital asset securities through the special purpose broker-dealer release on December 23, 2020. These releases provide the framework for a compliant path forward for crypto in the United States. I want to stress that point. There is a compliant path forward for crypto in the United States that the SEC has clearly laid out. Those who argue for new laws are simply not willing to comply with existing applicable securities laws and regulations. New legislation is not in the best interest of the investing public or the blockchain industry. Legislative efforts will take years to implement while the American public will continue to operate on reckless, unlawful platforms. In conclusion, the United States fosters innovation through the vibrancy of our capital markets. U.S. capital markets flourish under the established regulations of the federal securities laws overseen by the SEC and FINRA. In order for innovation to continue to thrive in the digital asset space, the protections afforded by the federal securities laws need to be in place. Proper regulation under the federal securities laws is not a hindrance to innovation, rather a prerequisite that will allow innovation to flourish. Thank you again for the opportunity to testify at this hearing, and I look forward to answering any questions.
I'll recognize myself for 5 minutes. Mr. Garrison, Dr. Sarir, let's start with you. Mr. Garrison, how many foreign regulators have proposed new regulatory frameworks for digital assets?
You're looking at about half a dozen to a dozen,
Okay, including Europe.
including Europe.
And Europe is,
Hong Kong.
Europe is far more advanced than we are. Okay.
Yes.
We see venture capitalists now deploying offices, American venture capital firms going there to seek to invest. Are other countries implementing new regulations around digital assets, specific to digital assets?
They are whole cloth new regulations.
Okay, and do you think consumers are protected here in the United States by our lack of clear rules?
No, they are not.
Okay. Dr. Sarir, how does the threat of enforcement action stymie innovation and hold back developers from new projects here in the United States?
Lack of clarity around regulations involving the issuance of tokens holds back quite a few innovators from actually residing in the United States, and we're seeing actual people who are active in this field move wholesale out of our borders to other jurisdictions.
And that's been pressure on you to develop your technology overseas, not here in the United States.
Well, I'm very happy to be in the United States myself, but I can see the pressure on other people.
Okay. Now, Mr. Garrison, in terms of the cost structure of potential action, enforcement action by the SEC, what does that look like for a firm? What does that look like? I don't want to get into the book of big law and what they charge, but it's not cheap, right?
It's not. You're hundreds of thousands of dollars and into the millions, depending on the charges.
Okay. So, as I said, we want a purpose-built regime for digital assets, right? We want it, same risk, same regulation. That's the focus. Mr. Sexton, in the draft here, we've said that decentralization is the key. If a digital asset association is associated with a decentralized and functional network, they'd be treated as commodities. Would the CFTC and your organization be able to serve as primary regulators over the digital commodity spot market?
Chairman McHenry, if that's the definition as far as a commodity is concerned, then the CFTC and NFA would be able to implement that definition within and regulate that in the spot market, yes.
Okay, so over here in the Financial Services Committee, we have securities law protections for consumers. We have consumer protection. That is a key part of our discussions. Is there like-kind consumer protection in the world of commodities?
Absolutely. Everything from segregation, capital requirements, risk disclosures. You monitor the trading that occurs, the exchanges do on the exchanges. This very similar type of customer protections are in place with regard to retail participants.
Dr. Sarir, about decentralization. What are the features? What are the end goal? What's the end goal state of a decentralized network, a functional decentralized network? What are the attributes of it? Give us some sort of, not your 401 class, maybe your 201 class from your college days.
Simply put, a decentralized network aims to provide a service wherein, even though some of the actors in the system might be what we call Byzantine, they might be acting in an adversarial fashion, the system is still able to maintain its safety and integrity guarantees for all of its users. These networks are more resilient than other computer network systems.
Okay. So we see the Securities and Exchange Commission ramping up their enforcement action, timed for our hearings. I would think that has to be some contemplation from our friends over there. What we're trying to build is consensus around changes in law, around a new object, a new asset, a new architecture, new digital architecture. Mr. Garrison, if you have an innovator who wants to set up shop here in the United States, in the world of digital assets, how would you advise them?
I tell them that the laws, the regulations are very uncertain, and often those conversations end with the entrepreneur deciding to either launch offshore or to drop the idea altogether.
So let's pivot to stablecoins. Mr. Allaire, where are you currently regulated? Where is Circle currently regulated?
Circle's regulated in a number of jurisdictions. We're regulated across the United States by state payments and banking supervisors. We're regulated in Singapore as a major payment institution. We're in registration with the French government, and we're also regulated by the FCA in the UK.
Do you comply with anti-money laundering rules here in the United States?
Yes, absolutely. Comprehensive BSA, AML programs, which we've had in place for a very long time.
Okay. Are you licensed in the state of New York?
We have a BIT license in New York, and we're also licensed as a money transmitter in the state of New York.
Okay. Thank you all for your testimony. I appreciate the wide-ranging panel we have here. I'll now recognize the ranking member, Ms. Waters, for 5 minutes.
Well, thank you so much, Mr. Chairman. I did not anticipate that we would have such strong advocacy for CFTC and for the SEC, so this is interesting. Mr. Kaplan, while Democrats are taking a serious look at the Republicans' market structure bill, I'm deeply concerned that some of the most basic investor protections are missing from the bill. First, any commingling of investor funds must be strictly prohibited. We saw with the collapse of FTX that much of the fraud and investor harm came from the commingling of customer funds, which enables CEO Bankman-Fried to steal his customers' property. The bill also seems to permit trading facilities to trade against their own customers and engage in other activities prohibited by today's security laws. Do you agree that commingling of customer funds should be prohibited? Will your firm commingle customer assets, Mr. Kaplan?
Our firm will not commingle customer firms and customer assets with that of the firm. Our model does not have proprietary trading or market-making activities. Thus, customer assets will not be commingled with firm assets because in that sense, there are no firm assets. And customer assets will be properly segregated as outlined by Securities and Exchange Act Rule 15C3.3. Now, when it comes to the investor protections of the federal securities laws, we saw the dangers of what happens when they're not in place with FTX. The federal securities laws would have done the most in terms of preventing an FTX-like situation. They ensure fair and orderly markets. They ensure that markets are not manipulated. They ensure that you can't trade against your customers' accounts necessarily. They also ensure proper segregation of customer funds and assets from that of the firm. These were major issues when it came to FTX, and they could have been prevented had there been proper regulation and oversight with the SEC. So in order for the best route going forward, I think the best way to protect the American public is with the application of the federal securities laws, which are purpose-built to protect investors. There's literally no need to recreate the wheel here.
Thank you very much. As a special purpose broker-dealer, are there activities you are prohibited from doing but that are permitted for crypto brokers in the Republican bill? And can you describe why the securities laws prohibit those activities and how changing the prohibitions would affect investors?
The special purpose broker-dealer is capable of custodying digital asset securities under the federal securities laws. Pursuant to the federal securities laws, there's filings and disclosures that must be submitted to the SEC, and these disclosures and filings include firm financials, possession and control reports, and as far as reporting, and it goes as far as requiring disclosures about firms' affiliates. Having these systems in place in order with the ongoing reporting, the proper oversight, and the for investor protections of the federal securities laws will ensure market participants are properly protected and are the best way to protect the American public going forward.
Mr. Kaplan, I also have concerns with what the bill refers to as provisional registration. Specifically, I'm concerned that this gives crypto firms that are violating our securities law a get-out-of-jail-free card. This provision seems particularly harmful because firms like Binance or even FTX, which have both been alleged of fraud, would effectively block the SEC from continuing its investigation. Are you concerned by this provision of the bill? What impact do you see this having on investors?
I'm very concerned by the provision of this bill, as the provisional safe harbor would essentially present a system where the American public is still exposed to the dangers that they were previously exposed to while that safe harbor goes to full registration. Furthermore, basically, when you look at the best way forward has to be to use the most robust system to protect the American public. And the most robust system to protect the American public is the federal securities laws. I'd like to point out the American public was the one left holding the bag when it came to FTX, and when it came to the violations or the alleged violations when it comes to Binance and Coinbase. And essentially, the best way to protect them going forward is to establish the most robust regulatory regime. The SEC and FINRA combined have 8,000 employees. The CFTC and NFA combined have 1,300 approximate employees. The best way forward is pretty clear and logical, is the application of the federal securities laws.
Thank you very much. I yield back.
Ranking member yields back. I recognize myself for 5 minutes. Last week, the House Agriculture Committee heard testimony from CFTC Chair Benham and former SEC General Counsel Berkowitz, who served under Chairman Gensler. And it was striking to see how both of those witnesses call for congressional action to address the gap in federal regulation of digital assets. And this mirrored the Financial Stability Oversight Committee's report last October. And this morning, for those of you who are not glued to C-SPAN here at the House, we had Secretary Yellen here for a very interesting morning. And she also suggested that she stood by that FSOC report calling for a comprehensive regulatory framework for digital assets. And she said, and I just would quote it for this hearing, "We'd like to see your regulatory framework over those markets and their gaps in regulations." I would point out specifically stablecoins. And I do believe we need a comprehensive federal prudential framework and would be pleased to work with you and the Congress to develop such a framework. So in my view, we have the CFTC thinks that this is the right direction to take because there are gaps in the system, notwithstanding the comments from Mr. Kaplan. And our Treasury Secretary seems to agree, as well. Mr. Garrison, I want to start with you because I think the ranking member brought this subject up. She had a good interchange with Mr. Kaplan about this provisional registration issue. It's very important. This was also discussed in the Ag hearing last week. It's a tricky area to get right, and we want to make sure we draft it in the best way possible. So this is a temporary provision, as I understand it, meant to bring digital asset firms into the remit of the SEC and the CFTC before rules of this comprehensive framework can be stood up. And this was similar to how we approached swap dealers after Dodd-Frank. Is that your understanding?
Yes.
So help us, and we patterned this drafting based on that. The last time the committee worked ably with the Ag Committee was in Dodd-Frank on looking at swap rules. Tough debate. I think Mr. Lucas and Mrs. Waters would agree to that. Why is a process like this needed, and how it can be structured to provide actual customer protection in the digital asset markets in the interim before those rules are written? Is that possible we can do that?
It certainly is. So the provisional registration or provisions, I think it's designed to acknowledge the reality that these markets exist now, that these trading platforms exist now, and that customers, consumers are using them. And so until the new rules are written, there are no rules of the road. So by requiring them to raise their hand to signal an indication of seeking full registration when the rules are provided, by committing to certain undertakings of meeting certain standards
So those standards might include books and record keeping, customer disclosure, segregation of customer funds, right? No one is letting somebody off the hook for those responsibilities, even under provisional rules, isn't that right?
Correct.
Do you have any suggestions on further refining provisional registration that would be best for both the regulators and the market participants?
Sure. So I think there is a provision exempting any actions against relating to fraud, and it sounds like there might be some confusion on that point. So I would recommend really drilling down and making sure that during that provisional period, obviously that shouldn't cover any fraudulent acts that would occur during that provisional period. So to the extent there is uncertainty on that seems like a good area to focus on.
Good, thank you. Last week, the Commission issued an enforcement action against Binance for failing to register as a national securities exchange, broker-dealer, or clearinghouse. More concerning was also the allegation that they were commingling customer assets with house assets and misrepresenting the controls to investors. This absolutely cannot be allowed to happen. We need clear rules of the road to prevent that kind of thing or another FTX. You've looked at our draft. Do you think that we have a good bill provisions on prohibiting commingling?
I think it does, both under the SEC side and the CFTC side.
And would it allow conflicts of interest to persist if we had the new framework in place?
It would not.
Mr. Garrison, Mr. Kaplan made a very good comments about his success in becoming registered under the Commission. Are there things that you saw that took place there that we should change in our bill about registering broker-dealers?
No, I believe the special purpose broker-dealer is limited to a certain universe of digital
My
assets.
time's expired. You can answer it in writing if you would. And I'll yield to my friend from Georgia, the gentleman, Mr. Scott's recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Kaplan, 90 years ago, Congress created our federal security laws to protect our investors and to establish robust regulation against misrepresentation and fraud in our securities market. However, since then, we have seen decades of legal precedent established that yielded consistently benefits to our consumers and our investors in the long run. Unfortunately, I believe that under this misguided digital asset market structure bill we're dealing with now, the fundamental approach to security laws is effectively undermined to the detriment of the American investor. And I am particularly referencing sections of the bill which gives much of the authority over digital assets previously with the SEC and instead placing it at the CFTC. And the bill would exclude also digital commodities and payment stablecoins from the definition of a security under the security laws. This is antithetical to current law, where an asset can be both a commodity and a security. So by creating an entirely new regime for so-called digital commodities, the bill eliminates the SEC's ability to determine what is or is not a security. So, Mr. Kaplan, what consequences may arise from this? Make it plain to us. This is the heart of the matter. Could this potentially result in less protection for our investors than is currently provided?
I anticipate that it would. Essentially, as you mentioned, the federal securities laws are tried and tested over generations. There's not just case law, there's follow-on legal precedent and additional regulations and basically continuing actions thereafter. And essentially, the concept of creating a new regulatory regime that would make a determination whether a digital commodity will exist will create sort of a void in between what we have now and when that is fully in place. It'll take maybe half a decade for those laws to be flushed out such that they might be viable. And in the meantime, we have an existing framework that's purpose-built, meant to protect investors, meant to ensure there's proper disclosures, meant to ensure there's fair and orderly markets, and basically that customer funds and assets are properly segregated and secured. So essentially, in the meantime, while all of this is sort of flushed out in the legal system and basically the digital commodity is operating in a semi-security capacity, because it's always arguably been a security, the investors participating in that space will not have proper disclosures and not proper protections and also not proper oversight to ensure they're properly protected. I also want to circle back to the provisional registration. The provisional registration really provides a get-out-of-jail-free card. Because essentially, when an entity registers or provisionally registers, the SEC cannot go after their previous actions. So in theory, if Binance or if FTX was still around were registered, once they became provisionally registered, those who suffered at the hands of the malfeasance of those entities would not have legal recourse. How is that in the best interest of the American public? It's not.
Well, Mr. Kaplan, I agree with you 100%. What do you think we should do about this?
Follow the existing federal securities laws, which have been tried and tested over generations and are literally meant to protect the retail investing public. It is a clear and logical pathway forward.
Thank you, Mr. Kaplan.
Gentleman from Georgia yields back. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Chairman, for holding this hearing and for your work and the full committee chairman's work on the digital market structure legislation. Both this committee and the House Ag Committee have had many hearings, many roundtables in the lead up to this draft. And this hearing gives us another opportunity to examine the underlying legislation and discuss why it's important for Congress to provide a clear regulatory framework. And I'll begin with this. If the United States wants to be a leader in the future of digital assets, it's essential that Congress act. Other jurisdictions, such as the European Union and Japan, have frameworks for digital assets, and countries like the UK are crafting their own rules. At the same time, our regulators here in the U.S. are at odds. We have the chairman of the SEC telling Congress that legislation is not needed, while the chairman of the CFTC says legislation is needed. Congress should settle this by passing much-needed regulatory clarity for digital assets, not jurisdictions abroad like the EU and not the SEC through a chaotic enforcement approach. Mr. Garrison, could you discuss how it makes our job passing meaningful legislation more difficult the longer we wait?
So the longer that it takes time to get legislation together, the more the trading public in digital assets are put at risk, where there's no rules in place. The longer that industry participants don't have certainty, the more difficult it is for them to continue to operate, and the greater the risk that they move offshore.
Mr. Allaire, could you further underscore the missed opportunity of allowing other countries to create a workable digital asset environment while here in the United States we allow the SEC to take the lead?
Thank you for the question, Congressman Lucas. Very specifically, we are seeing governments around the world, the EU, the UK, Japan, Hong Kong, Singapore, and others, actually defining the rules for how dollars, digital dollars, are issued and operate in those markets, which is astounding. The United States is responsible for the dollar, and the United States does not yet have clear regulation for payment stablecoins and digital dollar issuance. And so with respect to the different need for clarity, I think as recommended by Secretary Yellen and the entire President's working group, who've also led an effort internationally to establish stablecoin rules, we need to adopt stablecoin rules so that other markets are not actually regulating the dollar.
Many of the consumer protection concerns that we see today in the crypto market are reminiscent of the Forex markets of the 2000s, which were ripe with get-rich-quick schemes under an unclear regulatory framework. In 2008, granting the CFTC jurisdiction over leveraged spot retail Forex transactions provided tangible consumer protection results. Mr. Sexton, drawing upon your experience and tenure at the NFA, how important is it for Congress to act if we truly want to protect consumers?
Mr. Lucas, thank you for the question, and thank you for meeting with us yesterday. As a member of the Ag Committee, you worked with us on retail Forex issues, and it's extremely important in light of the similar type of retail customer fraud that occurs with regard to spot digital asset commodities, that a similar framework be built. We know that the CFTC has anti-fraud jurisdiction over these products currently. We need to complement that with regulatory jurisdiction as we did in the retail Forex space. As we've often said, it is far better to prevent fraud than prosecute fraud because retail customers have been hurt after that's occurred.
Mr. Sexton, of course, I understand you're still reviewing the implications of the market structure discussion draft, but could you discuss broadly how the National Futures Association would amend its compliance rules to account for Congress creating a classification for digital commodities? What would the process look like?
The process would be very similar to what we have done in the past when we have taken on additional responsibilities in the retail Forex and the swaps markets. The first thing that we would do is, as I said, we currently have a rule, anti-fraud rule for digital asset commodities that covers Bitcoin and Ether. Dependent upon what Congress derives as far as the definition for those products, we would amend our rules to cover those products. We also would amend our rules to permit digital asset commodity brokers and dealers to be members of an RFA, NFA, if we are participating in this. And then afterwards, we would adopt compliance rules in the areas that are identified in the discussion draft, working closely with the CFTC in doing so, from customer seg to capital disclosures. You go down the line as to the elements of the discussion draft.
Thank you for those insights. My time is about to expire, Mr. Chairman.
Gentleman yields back. The gentlewoman from New York, Ms. Velasquez, is recognized now for 5 minutes.
Thank you, Mr. Chairman. Mr. Allaire, as you know, the New York Department of Financial Services has developed its own regulatory regime providing for the legal issuance of stablecoins in the state of New York. There has been significant conversation on this committee about whether the federal government or the states should be the primary regulatory authority regarding stablecoins issuance. What is your view? How do you view the role of the federal government vis-a-vis the states?
Thank you for the question, Congresswoman Velasquez. This is a critical issue, and I know is central to ultimately getting stablecoin legislation done here in the United States. We believe there needs to be a strong role for both states and the federal regulators. I think that the bill, as noticed as of this Friday, makes very significant progress in establishing very strong federal floors on the requirements, reserve requirements, reporting requirements, redemption disclosures, commingling, not allowing that, and then very specifically allows the Fed and the federal banking regulators to deal with the rules around capital adequacy, core risk management rules, safety and soundness requirements, the kind of fitness of management, many of the fundamental things, and that becomes the floor that any state regulator needs to meet, but states would be allowed to issue payment stablecoin licenses and to supervise firms under that Fed floor. And I think that's a good compromise that allows states like New York, who've really led the way in stablecoin regulation in the United States.
Thank you for that answer. Mr. Kaplan, what is your view? How do you view the role of the federal government vis-a-vis the states when it comes to regulation of stablecoins issuance?
Under the draft bill, I think there is potential issues when it comes to the fragmentation and the different regulatory regimes. Essentially, a stablecoin could be licensed on a state level, but what happens if that stablecoin is used outside the state? Isn't it used in interstate commerce then? And therefore, shouldn't there be a federal oversight? I think the most appropriate way to ensure that investors and the public are properly protected, particularly when it comes to stablecoins, which arguably pose the largest and most systemic risk, is to have proper federal oversight that is uniform, that would prevent any sort of regulatory arbitrage where issuers would choose one state versus another because they're more friendly towards the approval process.
Okay, thank you for that answer. If you both, Mr. Allaire and Mr. Kaplan, if you both believe federal oversight is important, do you believe it is important to have ongoing supervisory and examination authority for the state license issuers at federal level?
So I believe that the Fed needs to be able to continue to enhance rules over time. In particular, the bill stipulates core areas around capital adequacy, risk management, safety and soundness. The importance of those is paramount, and federal regulators need to be able to look at what's evolving in the market and evolving on the whole and be able to make recommendations around that. And so this isn't a static one-time thing. I think that these are going to be dynamic markets and technology changes, and that will require that, that we be able to look at those on an ongoing basis.
Very short answer, Mr. Kaplan.
I think that there is specifically on the state level potential issues when it comes to the idea that the state can unilaterally expand the list of eligible reserve assets without restriction at any time. Expanding the underlying assets that could basically stabilize a stablecoin to include and introduce additional risks, which will increase the chance of that stablecoin losing its peg.
Thank you. Mr. Kaplan, one of the central tenets of our banking system is the separation of banking and commercial activity. The Republican-led stablecoin legislation we are discussing here today seems to fail to recognize this separation for stablecoin issuers. This would allow non-commercial businesses to own a stablecoin issuer. Can you explain the harm to both consumers and perhaps financial stability that could arise from failing to clearly define this separation?
Consolidation of consumer and banking activities can lead to conflicts of interest and potential systemic risk. Essentially, a lack of strong frameworks with properly regulatory oversight for the entities involved, particularly when they're commingling consumer and financial-based activities, presents additional levels of conflict and potential exposure to the underlying customers, either on the consumer side or
Thank
on
you,
the
Mr.
financial
Kaplan. Gentlewoman's
Thank
time
you.
has
I
expired.
yield
Thank you, gentlewoman from New York. And now the gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Allaire, you begin your testimony today talking about China's currency. Do you see any comparison between that and the central digital currency that the President has proposed in his executive order?
I'm sorry, I couldn't hear the last part of your question because the door opened.
So do you see any similarity between the Chinese program and the central currency that President Biden included in his executive order?
Thank you for the question, Congressman Posey. I think what the Chinese government has pushed forward with is an entirely state-run and administered digital currency program. It has with it significant embedded surveillance capabilities, and it's clearly something that the Chinese government seeks to export around the world as part of its desire to grow the role of the yuan internationally. I mean, I believe your reference to the executive order from President Biden was around studying central bank digital currency in the United States. Our view is that a similarly designed retail, government-run and administered central bank digital currency is not needed in the United States, but we do believe that there are critical improvements to be made in the core infrastructure of the dollar itself within the Federal Reserve System, what sometimes people refer to as wholesale infrastructure for this. And clearly central banks around the world are all exploring that. But I think this separation between those institutions that are delivering financial services directly to end customers and the government is a kind of air gap that is important to preserve for privacy, security, and market competitive reasons.
You can understand a concern of some people that if private digital is competing with government digital, guess who's going to win? it's never going to be a level playing field, and more levels of regulation isn't going to help. I mean, we know the SEC let the biggest fraud in history go. For 10 years, they were informed about it. So, you know, more regulation is not going to fix the fraud that we endure. And there's also concern, you know, when you have a central bank digital currency, and like China has, the government knows every penny that you spend. They can slow down your flow of funding. They can cut it off, or they can take everything that you have. And I can understand the legitimate concern that some people have about that. How should investors evaluate liquidity risk of digital assets compared to banks?
So specifically on stablecoins, what this bill does is specify a very narrow base of important high-quality liquid assets that must be held on a fully reserved basis, the most liquid dollar instruments in the world. And a digital dollar that is held to those reserve standards is dramatically safer than bank deposits. Bank deposits hold 1/12 of the deposits. The remainder is lent out. We see risks from fractional reserving. And the mixing of that lending behavior and payment system behavior has, let's just say, bitten the American consumer and business many, many times historically. And so this bill, I think, helps to define and create the safest digital dollar in the world, which is what the American government should be getting behind and making that an important export product on the internet.
How should the regulations for stablecoins compare to the capital regulations for banks and money market funds?
So in the stablecoin bill, there are recommendations for federal regulators to look at capital adequacy, to evaluate key activities around the risks of an issuer, and I think that's appropriate. There should be capital buffers to deal with it. But unlike a bank, which is rehypothecating and lending and fractionally reserving, these are very, very narrowly held. And so the liquidity requirements are, and therefore the capital buffer requirements are likely going to be significantly lower. And so that is left to regulators to determine, as opposed to being highly prescriptive in the bill. But I think it's a very important and necessary piece for this to ultimately go into effect.
Thank you. Mr. Chairman, my time has expired.
Gentleman yields back. The gentleman from California, Mr. Sherman's recognized now for 5 minutes.
Thank you. This seems like the 12th hearing we've had on crypto this year. I'm still waiting for a hearing on diversity, equity, and inclusion in this room this year. But all these hearings seem to start with the idea that we're falling behind. America is behind Peru in cocaine cultivation. We are behind the Cayman Islands in nefarious hidden financial transactions. We don't always need to catch up. We're told that we now have a 160-page bill, and I'm sure a lot of work has gone into that bill, but it comes down to the one sentence and the one reason why Sam Bankman-Fried prowled the halls of this building, and that was to get the SEC out and put a patina of regulation in. Then there is the proposed stablecoin bill that goes to the lowest state denominator. And what state, if they could have $1 billion to provide health care for their own citizens who might die, what state wouldn't cut that deal and just provide whatever patina of regulation the industry wanted? And if North Dakota won't do it, South Dakota will. So we'll have achieved Sam Bankman-Fried's objectives. The least we could do is let him out of jail to come here and celebrate this is legislative success. When billionaires tell you that they're working to hurt your country, you should believe them. The head of Coinbase, Brian Armstrong, tells us that he views crypto as a new global reserve currency. And we see from others that this is the way, major figures in the crypto industry, that we can, a way to undermine American sanctions. The role of the US dollar allows us to have the know your currency rules Crypto says it's hidden money. That's the name. Undermine our sanctions rules, provide a tool for tax evaders, but most importantly is what Mr. Brian Armstrong, CEO of Coinbase, says, and that is to displace the dollar partially or completely as a reserve currency. We're told that we need clarity. We have clarity. The SEC realizes it's a security, as Mr. Kaplan does as well. The industry is here to spend, well, first they're in court spending tens of millions of dollars to undermine that clarity. And then they're in Congress spending God knows how much to undermine the clarity that we could have tough regulation from the SEC, and that's what our laws currently call for. I've got a question for Ava Labs. Avalanche Labs attempts to highlight their use of technology to focus on innovation, but still peddles unregistered securities to retail investors. The Avalanche token went from a market cap of $40 billion to $4 billion. Mr. Serrier, did Ava Labs file a registration statement with the SEC? Has Ava Labs sold unregistered Avalanche tokens or a future right to Avalanche tokens to raise capital?
Congressman, we complied with every regulation to the best of our abilities, and we are.
Did you file a registration statement or not?
When we did our token sale, we filed an appropriate.
Did you file a registration statement or not?
I do not know the correct answer to that. I'm a technologist. I don't know the answer to that. I believe that we did not.
Well, that would certainly surprise me. I mean, Taylor Swift turned down millions of dollars and responded to the community by saying crypto is an unregistered security, and she would turn down millions of dollars to be associated with it. Some people in this room are not willing to make that statement. Mr. Kaplan, you're able to comply with SEC regulation and carry on your business?
Yes, sir.
You filed a registration statement?
We filed through the licensing process.
So you got a license from the SEC. I would just say that we've had a lot of witnesses come before us, but we've had, I believe, not one who came here to talk about how if this works, it undermines the power of the American people.
The gentleman's time has expired.
Yield back.
I thank the gentleman from California. The gentleman from Missouri, Mr. Luchtermeyer, the chairman of the National Security Subcommittee, is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to quote from an article in the Wall Street Journal last week entitled, "Crypto Communism Has a New Meaning. China Seeks to Infiltrate the U.S. Financial System, and SEC and FINRA Seem Oblivious." And in this article, it talks about Prometheum as an American company, but according to SEC filings, is a strategic partner and joint venture with Shanghai Wansheng Blockchain Incorporated and its affiliate Hashkey. The former company is a spin-off of Wansheng Group, which has deep ties to the Chinese Communist Party. Wansheng Group was founded in 1969, and the founder passed recently, and an official press release commented that the comrade always listened to the party and followed the party. That group is now led by that gentleman's son, Lu Wangding, and the press release is almost identical by saying that he will carry forward the practice of the deceased founder and always listen to the party and follow the party. I can tell you from being on the Chinese Select Committee, that is a chilling statement when we have an American company that's in bed with the Chinese. Mr. Kaplan, what percentage of your company is owned by a Chinese entity?
I think approximately 20%.
20% of it. How much influence do they have over your company?
They have the same rights as other shareholders.
How much access do they have to intellectual property?
Wang Zheng has no access to any Prometheum code or technology or system, server, or customer data.
If they're on the board of directors and have access to all your data from the standpoint of being an investor, how do you answer that question like that?
The bylaws were changed in the filing that was filed with the SEC on November 2021, and they basically limit who has access to data, including directors.
Okay, where is the data stored right now?
In the United States?
Okay, your headquarters is here, your data is stored. It's not stored anywhere in China.
Not at all, sir.
Okay, you had a designation as a digital asset security broker dealer, and as such, you have a lot of person identifiable information on your clients, do you not?
Correct.
Okay, does any of that information or any of the technology have, does the Chinese have any access to that at all at this point?
Absolutely not, sir. I want to point out Prometheum is an American-born, bred, and controlled company, and basically no foreign influence or control over Prometheum is had to any of its systems, its code, its servers, or its customers' data.
Well, I'm glad you could read that, but that doesn't impress me because I sit on a committee, and I can tell you any company that is either owned by or are involved with the Chinese Communist Party and or government is influenced by them. That's the only way they operate. And so what safeguards have you got in place to make sure they don't get anything that's in your company?
Sir, we both had a CFIUS inquiry and an SEC investigation where we were required to give all communication.
So what benefit do the Chinese then involve themselves in your company? If they can't access it, if they can't access information, they can't access your technology, what's the benefit of them investing in your company?
The belief in the business idea that digital assets are securities and need to be properly regulated as such and traded on intermediaries that are properly registered under the securities laws.
Do you think that perhaps they're getting some information just by being around your business that could be helpful to them?
I do not believe so, sir.
Why did you take them on as a partner? Why can't you have an American partner instead of a Chinese partner? What's the benefit of having a Chinese partner in this business?
As anyone who's started a startup knows, when you are young and small as an entity and a large established entity seeks to have a relationship with you, you look for the opportunity. If there had been an American opportunity, we probably would have taken it.
Well, that's troubling because you see, this is exactly how the Chinese work their way into our various companies in this country. They see an opening because there's a need there for the company to grow, for money, for expertise, for technology, and they're standing there with their hands out, being willing to add that to the portfolio or give to whatever you want to do here. And as a result, then they've got their hands on you. It's very disturbing to see that that's what's going on here. So I'm just worried that this is a situation, and here we have the SEC giving you one of the first digital asset security broker dealer's license. It's where's the SEC on this, I'm wondering. But anyway, I see my time is getting short. With that, Mr. Chairman, I'll yield back.
The gentleman yields back. The gentleman from New York, the ranking member of the Foreign Affairs Committee, Mr. Meeks, is recognized for 5 minutes.
Thank you, Mr. Chairman. I think most of you know I'm from New York, and I think you're all aware that the New York Department of Financial Services has created what I believe is a best-in-class licensing regime for virtual currency businesses, which I'm very, very proud of. And New York DFS is the only prudential regulator with virtual asset-specific authority in these United States of America. Under the leadership of Superintendent Adrian Harris, DFS ensures that consumers and markets are protected, and New York continues to be the financial center of the entire world. They've assembled the largest team of expert virtual currency regulators in the nation and have taken the strongest supervisory and enforcement actions of any regulator. So let me ask Mr. Allaire, who would you consider to be Circle's primary regulator?
Thank you for the question, Congressman Meeks. We are regulated similarly to virtually every other major electronic payment innovator in the United States. So we are regulated by many different state regulators throughout the U.S., similar to PayPal, Apple Pay, Venmo, Cash App, and others. So we're electronic stored value money transmission application, which requires us to be licensed, both a filing with the Treasury Department, BSA, AML requirements with U.S. Treasury, as well as licensing and supervision throughout the United States. We also have international supervisors that are central banks and market supervisors. We are also a BIT license company. In fact, we were the very first company in the world to receive the New York BIT license. In 2015, we contributed to the development of that licensing regime. and we follow New York's reserve and disclosure requirements for stablecoins, which we would agree are some of the best available to the market today.
So are you saying, I just want to make sure that I'm clear, does Circle currently possess any type of virtual currency license in the domestic jurisdictions? Is that what you?
Yes, we have a BIT license, which is the New York virtual currency license, which they pioneered in 2015. Other states also have specific enhancements to their money transmission statutes that deal with virtual assets and interactions between the banking system and virtual assets. A number of large states do that already today. We're also supervised by international banking regulators such as the Monetary Authority of Singapore, the UK FCA, and others.
So let me, you acknowledge that states like New York have been leaders in this space, and you agree that they have a vital role to play, is that correct?
I absolutely agree.
So can you speak to why the existence of a state pathway is not a race to the bottom?
So I believe payment stablecoins, as identified by the Presidential Working Group and by the G20 as well, have the potential to be very large scale, much larger scale in use than many other payment technologies. And for that reason, it's been recommended that, by U.S. Treasury and by the White House and others, that there be national standards set for payment stablecoins. And I think that's exactly what, on a bipartisan basis, we're seeing happen here in Congress. And what's really key there is that there is a federally defined floor, that we do have the ability for federal regulators to define what that floor is so that there can't be a race to the bottom. And I believe the best states should be able to issue licenses and supervise firms according to this federal floor. And I think that's exactly what the legislation in front of us considers today.
Thank you. Let me jump to Mr. Garrison. Mr. Garrison, your assessment that the lack of clear rules of the road puts the United States at a competitive disadvantage deeply resonates with me. It's something that I've been talking about a lot. Like you, I hear regularly from U.S. companies that the lack of regulatory clarity at the federal level is causing them to consider moving out of the United States and seek to be regulated in other jurisdictions around the world. So I'd like to give you an opportunity to expand on this and share some of your observations in this area, and what are some of the potential near-term and longer-term impacts of industry participants leaving the United States.
So the regulatory uncertainty is tremendously difficult for people as they want to grow a business. And when they seek legal counsel and when they come to people like me, they are willing to spend money to comply with the law. They just simply need to know what the rules of the road are. And so it becomes incredibly frustrating when there is no clear rules of the road, and all you know is that an enforcement action may be hanging over your head, but there is no actual way to compliance. So one of the good things about—
The gentleman's time has expired. I thank the gentleman from New York. Gentlewoman from Missouri, Mrs. Wagner, the chairwoman of the Capital Markets Subcommittee, is now recognized for 5 minutes.
I thank you, and I want to thank Chairman McHenry and our chairman of the Digital Asset Subcommittee, Mr. Hill, for their efforts to develop a much-needed framework that provides clarity to market participants, it promotes innovation, and protects investors. This hearing is timely, and the legislation that we're discussing today is critical to ensuring the United States remains the leader in technological and financial innovation. While Congress has been working toward developing a legislative framework, SEC Chair Gensler continues to regulate by enforcement. The SEC is actively policing digital asset markets through enforcement without clear authority from Congress and without providing a clear regulatory roadmap for digital asset firms. Meanwhile, the Commodity Futures Trading Commission, CFTC, has brought enforcement actions as well, including with regard to digital assets that the SEC claims jurisdiction over. Mr. Allaire, although the collapse of FTX did not involve payment stablecoins, one of the most egregious stories to come out of it was the commingling of customer and firm assets. Following your review of the draft legislation, does this draft fix the problems that we saw in FTX so we can provide increased protections to Main Street investors?
Thank you for the question, Congresswoman Wagner. I believe both in the payment stablecoin bill and in the draft market structure bill, I do believe that those commingling issues are absolutely addressed. And I think that's a critical issue that you've identified, and obviously a core to whether you're holding funds backing a stablecoin or you're holding digital assets that are on behalf of investors and users.
Absolutely. Last week, the SEC issued an enforcement action against Coinbase, alleging that they were operating as an unregistered broker-dealer, exchange, and clearinghouse. This action came after several requests from Coinbase, including a petition for rulemaking to amend the securities laws so that they could actually come in and register with the agency. Mr. Garrison, in your view, does this inaction on valid requests from the SEC, followed by harsh penalties against Coinbase, inhibit companies making good faith efforts to register, thus preventing job creation and economic growth within the stablecoin market, sir?
It certainly does. The lack of a regulatory framework makes operating a digital asset business in the U.S. very difficult. So allowing digital asset markets to operate with the acknowledgement of certain realities, such as instantaneous settlement of trading of digital assets that may be represented by securities alongside non-securities at the same time, these are important, things to acknowledge. And I think this bill does a good job of identifying that and telling the SEC to start putting a regulatory framework in place.
Okay, Mr. Garrison, the proposed legislation requires the SEC to modernize a number of its rules to account for the realities of digital assets, including rules governing alternative trading systems and broker-dealers. Would you describe how these rules could be updated to accommodate digital assets and what impact these modernizations will have on the digital asset ecosystem?
So the secondary trading rules need to be updated to acknowledge that not all intermediaries are necessary, which is one thing that digital assets make possible. So those are rules that, by the way, even at the end of these enforcement actions, if the SEC is successful, these rules still have to be updated to allow for these realities of the technology to occur. So it's something that the SEC can do now, and the good thing about this bill is it requires them to act now as opposed to waiting till after the enforcement action.
And as my time is short, Mr. Garrison, development in the blockchain space is accelerating rapidly. Yet existing regulations make it difficult for everyday investors to participate in initial offerings. The new exemption in the bill allows participation of non-accredited investors up to a certain limit. How will this access benefit retail investors?
Improving investor choice is an important part of investor protection, as well as the key characteristics here of...
Are there protections too, sir?
Yes. So the disclosure requirements are included in the bill, the individual investment limits, the aggregate offering limits. There's limits on insider trading secondary trading from insiders as well.
My time's expired. I'd be interested in any other protections that you think should be added to the legislation. I thank the chair and I yield back.
Gentleman yields back. The gentleman from Massachusetts, the ranking member on the Digital Assets Subcommittee, Mr. Lynch, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Kaplan, I'm going through the bill itself, and it's remarkable that the Securities Exchange Act actually reads out of the law 4 major pieces of legislation that have been intrinsic to strengthening our markets. The Securities Act of 1933, gone. Securities Exchange Act of 1934, gone. Investment Company Act of 1940, gone, does not apply. Investment Advisors Act of 1940 does not apply. Sarbanes-Oxley sign-off of annual reports, gone. Matter of fact, annual reports are gone. All of these bills were put in place, right after the stock market crash in 1929. And because we had 9,000 banks in this country go out of business, fail, Congress, with the support of Wall Street, amazingly, at the time, came back and said, how do we restore the trust of investors in Wall Street, in the stock market, in our banks? And we came up with this menu of bills that tried to restore confidence since our financial system is built essentially on trust. And we got trust by providing public information to those investors right up front to build confidence in their investments. You've been able to follow those rules in establishing Prometheum. What do you think the consequences will be if new companies have the choice of either being regulated or as Gary Gensler has pointed out, operate like the Wild West? Where do you think, and especially if it's a state-by-state model where you can go to a state like New York, which has an established regime and somewhat of a regulatory framework, or you can go to some other state that is very loosely regulated. What do you think the consequences of those choices will be on the markets?
The American public will be harmed. Essentially, what we've seen is that the Wild West crypto financial services ecosystem focused on revenues at the expense of customers' best interests. The way forward, the best way, really the only way forward, is the application of the federal securities laws to ensure investors are protected. As you mentioned, sir, the major acts when it came to the securities laws were passed after the 1929 crash. We learned our lessons then. Regretfully, we didn't understand them now when we're in 2022, but now, in hindsight, it is totally clear that the best way forward and the best way to protect the public is literally the application of the federal securities laws. Now, I want to point out there's been discussion about a lack of regulatory clarity, and that's just not true. The SEC put the industry on notice in July 2017 in the Dow Report. The SEC has released compliant frameworks for the trading and custody of digital assets. Those who argue that there is a lack of regulatory clarity need a lack of regulatory clarity because they can't be compliant under the existing clarified regulations.
Mr. Kaplan, so the SEC has brought 130 enforcement actions and has won every single one of them. After each and every one of those enforcement actions, there's a written decision as to why that individual company was found in non-compliance. Is that instructive to the next company coming along? Is that instructive to you as a new startup?
There has been clear indication, whether it's on the release, the enforcement side, or the statements coming out of the SEC that the federal securities laws applied, and that those seeking to operate compliantly in the space when it comes to digital asset financial services need to comply with them. Basically, there's no confusion here. Essentially, the industry has chosen to ignore the clear statements, the enforcement actions, and the releases by the SEC because they were best served by not being regulated under the federal securities laws.
Thank you. We have a few seconds left. What are the steps? What are the steps for registering and coming into compliance under existing laws? Is it onerous or is it balanced?
The steps are difficult, they're a little complex, and they take time, but they need to because when you're dealing with customer funds and assets.
The gentleman's time has expired. I thank the witness. Appreciate my ranking member and his good questions. Now yield to the gentleman from Kentucky. Mr. Barr is recognized for 5 minutes.
Thank you, Mr. Chairman. Let me start with Mr. Garrison and follow up with Mr. Kaplan's testimony. It seems that Mr. Kaplan is making the argument that everything except Bitcoin is a security. I want you to amplify your testimony in reference to this, what I think is Mr. Kaplan's testimony. In your written testimony, you talk about how the application of existing security laws that Mr. Kaplan says are perfectly applicable in this new innovative marketplace, that the application of these existing security laws to digital assets is not always clear, and amplify your analysis of how Howey doesn't really cover everything in the current modern world.
Yes, so we always start with the statute when the analysis of what is a security. The statute is quite clear in a list of instruments. Digital assets are not there. So then the question becomes, is it an investment contract? The Supreme Court in the Howey case put forth a test. It said a contract, a transaction, or a scheme where there's an investment of money in a common enterprise with a reasonable expectation of profit from the efforts of others is the security. Now, a digital asset at times can in fact be sold pursuant to an investment contract. That does not mean that the digital asset itself evidences the security for all of time. That set of promises that may have been launched if a project is getting off the ground and developing the network for the first time and raising money to do that, that's selling a token pursuant to an investment contract. But over time, tokens operate differently. They're not equity securities. They're not your traditional stocks or bonds or notes. People purchase them for a number of different reasons, but one of the reasons is they want to use it on the platform itself, on the network itself. So at some point in time, when the network is fully decentralized and fully functioning, that digital asset does not bear the characteristics of a security, and the application of the securities laws would be so overly burdensome that it would render the use of the network moot.
So in summary, what do you make of Mr. Kaplan's argument that existing securities laws are all we need?
I disagree with the position. I think securities laws are a piece of the puzzle, but I think there's a large piece of the puzzle that is missing.
Let me follow up with a question about custody. It's essential for any market structure legislation to set rules for the custody of digital assets so that consumers can have confidence that their digital assets actually are where an intermediary says they are. Digital assets raise several novel issues when it comes to custody that must be addressed. Mr. Garrison, would you discuss some of the key questions when it comes to the application of the SEC's requirements for custody of digital assets?
So, with respect to custody of digital assets in the SEC, there's a number of different questions relating to the intermediaries that may hold digital assets, typically broker-dealers, sometimes investment advisors. Generally, one of the questions that comes up and the core becomes, how do you demonstrate exclusive possession of a digital asset? The way digital assets work is you have private keys, and of course the private key may be shared with others and may be charted and put into different groups. So a lot of the securities regulations or debates going on in securities regulation is how do you actually show exclusive control? Now, the industry has a number of solutions that they think is sufficient, and the SEC has been talking about it and refusing to come up to a conclusion since, I want to say about 2018 on the subject.
Well, here again, the status quo is unacceptable. It's stifling innovation. The banks tell us that not just the SEC, but also the bank regulators are discouraging the safe custodying of digital assets, and that is stifling innovation here in the United States. We've got to fix that. Final question to Mr. Allaire related to China. Can you touch on how the United States can build out our stablecoin regime to elevate the United States leadership in the space without jeopardizing Americans' access to freedom, privacy, and apolitical private capital, and talk about that in contrast to what we see in China with the Chinese digital yuan, which has embedded surveillance features?
Thank you for the question, Congressman Barr.
And could you also touch on how a regulatory framework for stablecoin, dollar-denominated stablecoin, is an effective alternative to a CBDC or a digital dollar that would preserve the dollar's dominance globally?
My time is very short. In short, I believe private sector innovation with strong regulation at the national level for digital dollars, which is what this bill provides, is the best path to compete with China right now.
Thank you. And it's a longer answer, but I appreciate the answer.
Gentleman's time has expired. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the ranking member as well. Thank the witnesses for appearing. I think a good many topics have been covered quite thoroughly, so I'd like to go into another area. I'm interested in diversification, diversity. I believe that this industry ought to have diversity. And I'd like to ask you if you agree with me. If you think that this industry should be diversified in terms of people who are involved at all levels. If you think it should be diversified at all levels, would you kindly extend a hand into the air? All right, let's let the record reflect that all of the witnesses believe that we should have diversity at all levels. Are there women who are capable, competent, and qualified to testify at a hearing like this one today? If you think so, raise your hand, please. Let the record reflect that all of the witnesses believe that there are women who are capable, competent, and qualified to testify at a hearing such as this. If you identify yourself as a person who is not N-O-T, not a male, raise your hand. Let the record reflect that no hands have been raised, so I assume that all of the witnesses identify themselves as males. I must tell you, I find it quite amazing that as far as we've come, we still have a way to go. And I don't fault you. I really do not. But I do fault my colleagues. Not one female among the persons who are on this panel. Not one. I'm amazed because they know that I'm going to point it out, because I do this quite regularly. But I'm also amazed because this could end if the news media would make an issue of it. And just note that we're not allowing women to have the opportunity to demonstrate that they are capable, competent, and qualified. And if you have children, raise your hand, please. If you have a daughter, raise your hand, please. Okay, let's start with the gentleman at the far end. Sir, would you like to see a female on this panel?
Absolutely.
You think your daughter would benefit from having a female on this panel?
I do.
When you came in and noticed that you had all what facially appear to be men, did it give you any degree of consternation?
I would like to see more diversity in all of these panels.
So would I. We have come so far, yet we have so far to go, it seems. Mr. Kaplan, in your business, do you have any women?
Yes, sir.
Are women as smart as men?
Arguably smarter.
I agree. What about you, Mr. Sexton? Any women in your business?
Absolutely, sir. NFA is 40% women, 60% male. I have 2 women behind me that are fully capable of testifying at this hearing who helped prepare me for this hearing. Also have a daughter who would, I'm sure, thoroughly enjoy testifying before you.
Thank you. Just to validate what you said about 2 women behind you, would you feel it an imposition to just have them raise their hands? Would that be an imposition?
I'm certainly sure that they could raise their hands, sir. Thank you.
All right, ladies, women, if you would, raise your hands.
I'm sorry, the gentleman's time has expired.
Okay. My time always expires, so I'll be back.
Not always. The 5 minutes goes by fast. The gentleman from Minnesota, the majority whip of the House, Mr. Emmer, is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to thank Chairman McHenry for holding this important hearing today, and I want to thank all the witnesses for your testimony. We're convening to discuss a remarkable piece of draft legislation on digital asset market structure. It's a product of joint committee collaboration, which here in Congress doesn't happen often, and it's drafted thoughtfully and intelligently. I want to commend Chairman McHenry, Chairman Thompson of the Agriculture Committee, and both of their teams for all their hard work. Crypto will thrive with or without the United States. What we seek to do today in discussing this draft is to establish if the next iteration of the internet is going to be designed by Americans and for Americans, or if it's going to emulate the values of some other country. It must be the former, not the latter. American digital asset innovators and entrepreneurs desperately need regulatory clarity, regulatory certainty, regulatory confidence, and regulatory competitiveness, the 4 C's. Instead, as a product of Congress succeeding its power to the administrative state since the mid-90s, this administration has been able to abuse its regulatory power toward the digital asset ecosystem to the detriment of the American people. We have an SEC chair who flip-flops before Congress, telling us last year that he needs legislation to regulate the digital asset industry, and telling us this year that he has changed his mind. He actually does have the authority in his own mind, the statutory authority to regulate this space. I would disagree, but obviously this sends mixed signals. The SEC and the CFTC, the 2 potential primary regulators, are constantly at odds on what digital assets are commodities or securities. This sends, again, mixed signals to stakeholders. This administration weaponized the recent bank crisis to debank the digital asset community, deploying an Operation Choke Point-style assault on this legal industry. We have enforcement actions almost every week alleging different tokens are securities or different actions fall under SEC jurisdiction. Yet the SEC has failed to produce a single rule or regulation to help the unique digital asset industry come into compliance, a failure of the administrative state. Congress needs to step into the driver's seat and pass a bill that provides regulatory clarity, certainty, confidence, and competitiveness. I believe the McHenry-Thompson bill can get us there. It sets up a dual registration framework that allows projects to crowdfund and gives tokens a mechanism to move from issuance to decentralization. However, the way it is currently drafted conflicts philosophically with how I consider this asset class. Fundamentally, I don't believe digital assets themselves are ever securities. Instead, I believe digital assets can be obtained through a securities contract. The distinction between investment contract and the asset of the investment contract underpins my 8 years of legislative work in this space, and it's a basis of my bill, the Securities Clarity Act, which I was fortunate to have Mr. Thompson on as a co-sponsor last Congress. Primarily, while I know this is not the author's intention, my concern is that the McHenry-Thompson bill as drafted currently sets up a framework where one fungible digital asset can be both a security and a commodity at the same time. On its face, that is not possible. For one thing to have 2 distinct classifications, that's not possible. That's because the SEC does not clearly distinguish the asset from the investment contract. In current law, securities inherently include commodities. Let's go back to Howey. The orange groves themselves were obviously a commodity, but they were obtained through a securities contract. Nonetheless, the SEC considered those orange groves a security rather than the asset of a security, but it did not consider all other orange groves a security. The SEC does this today with digital assets, which, if continued, makes it impossible for digital assets to be in compliance with the law and to be used for their utility. Chair Gensler gave a speech just last week discussing his belief that the asset of the investment contract is itself the investment contract. Completely bogus. For the text to achieve what the authors wanted to achieve, which is to enable a framework in which a project can crowdfund and still create an asset that can be used for its utility, then the text needs to clearly assert concepts established in the Securities Clarity Act, that a token is separate and distinct from an investment contract. This will allow the bill to provide the necessary regulatory clarity, regulatory certainty, regulatory confidence, and regulatory competitiveness to ensure the next iteration of the internet is designed by Americans for Americans. Again, thanks to our witnesses for being here, and thanks to Chairman McHenry and Chairman Thompson for your work in this framework. I yield back.
Gentleman yields back. The gentleman from Connecticut, the ranking member on the House Permanent Select Committee on Intelligence, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses. I'd like to thank the chairman and Chairman McHenry and the ranking member for starting down this path. It's evident that we've got a bunch of work here and that we have a bunch of work yet to do. I want to use my time just to try to elucidate one issue that has come up a lot today, and that is the issue of commingling. There's a lot that needs to be done in this bill, but we're all pretty attuned to commingling given the fact pattern around FTX. So I was told that the bill permitted commingling. Mr. Garrison, you said the bill did not permit commingling, so I went back to the language of the bill, and what I find when I look at it is on page 105, commingling prohibited, money, assets, and property of a customer described in clause 1 shall be separately accounted for and shall not be commingled. Then we move down a few lines to exceptions, where it reads, notwithstanding subparagraph A, money, assets, and property of customers of digital commodity exchange described in subparagraph A may, for convenience, comma, be commingled. Elsewhere in the bill, there's an exactly parallel construction where it says that all assets shall be segregated unless they cannot be segregated if separately accounted for. So it would appear that, as written, the language is that there can be commingling provided that it is done for convenience. I can't find anywhere in the bill that defines for whose convenience or what convenience means. So, Mr. Garrison, since you made the statement earlier and because of your experience, I'm wondering, does that language give you confidence that there will not be commingling?
So if I remember correctly, and I don't have the exact language of the bill in front of me, I think there was a specific carve-out for a very limited activity. So to the extent that there is a carve-out for a very specific activity that is very clear, there's a purpose for that, then I would, I think that would make sense. But
well, I don't mean to provoke here, but I've read this 10 times now, and it says that for convenience is the one condition that must be met for commingling to occur. That's pretty clear here. I'm not a lawyer, but that troubles me. You are a lawyer. Does it trouble you?
I would agree. For convenience should be tightened up.
Okay. Mr. Kaplan, I wonder if you have any views on this, since you've been seeing things slightly differently than Mr. Garrison.
Commingling is a fundamental issue that is necessary to deal with and to regulate properly in order for crypto innovation to continue to occur in the United States. The best way to prevent against commingling is the application of the federal securities laws, which have reporting mechanisms, ongoing reporting mechanisms, and proper oversight, and a plethora of other devices to ensure that the entities that are holding customers' assets do not commingle them with the assets of the firm, particularly 15C33, the customer protection rule, which has been established and has essentially led to the capital markets on the custody side being able to continue to thrive and grow.
Okay, so just to drive this point home, I think we've agreed that perhaps the language is written is a bit broad, or the exceptions are a bit broad. So do any of our witnesses have objections if we use the language associated with prohibitions on commingling in custody accounts and that sort of thing to prevent commingling inside this bill? Would there be an objection to that as a concept? Okay, I hear none. Thank you very much, and I yield back, Mr. Chairman.
Gentleman yields back. Gentleman from Georgia, Mr. Loudermilk's recognized for 5 minutes.
Well, thank you, Mr. Chair. Mr. Garrison, in your written testimony, you point out that SEC staff has taken a position that digital assets may or may not be securities depending on the condition of their underlying network, but do little more to clarify the thresholds of which a network is decentralized enough for the asset to be a digital commodity. Given that almost every market participant has asked for clarity when digital assets are commodities or securities, why do you think it's important to look at the underlying network as opposed to the digital asset itself?
So I believe that looking at the underlying network is important because it will show the regulator, it will show anybody using the network who actually is in charge.
Okay.
If the network is decentralized and everybody comes on equal terms and the rules are being built by a decentralized group, a number of people outside of just a core number of folks that started the program, then that should give you more comfort that this is a decentralized network, not something that is simply run by a centralized group of people.
Okay, thank you. Do you think it's important that there are clear thresholds of decentralization that can be used to make the security commodity distinction?
Yes, I do.
What do you believe is a good measure of network decentralization to help in making that distinction?
So I think there's a number of factors that you can look at. One being, does any person or group of persons have unilateral authority to change the code itself? I think that's something that jumps out. Can they block or prohibit people from interacting with the code on their own? Another is concentration of ownership of tokens. If there are governance rights associated with a token and a central group or a central entity can always decide the outcome, well, then that would indicate centralization as well.
Okay, thank you for that. Mr. Kaplan, your company recently received the first ever approval for a special purpose broker-dealer for digital assets. Since then, you've publicly proclaimed that there is obviously a way forward for crypto in the United States. However, while your company was approved, most of your would-be competitors are still waiting for their approval. You've already begun discussing Prometheum as an, quote, SEC-registered platform, even though, respectfully, your firm does not command the same recognition as countless other platforms that are more familiar to consumers. It seems that you're keenly anticipating the increase in market share that will come with SPBD approval. Given that you're the only SPBD for digital assets around, do you really think experience can speak for market participants as a whole?
I do think it can. Previously, there were frameworks for the compliant trading and custody of digital assets under the securities laws, but until someone was approved, you can argue that there was no pathway forward, that there was no clear path. But that argument's now moot. And essentially others, I believe, in the industry can follow that example of compliance under the securities laws, understand that there can be success at the end of that endeavor, and basically put those practices into place in order to achieve compliance.
Okay. In your written statement for this hearing, you claimed that it was clear that a joint development agreement with Shanghai, if I pronounce this right, the Wenjiang blockchain, a company that has known ties to the Chinese Communist Party, was not viable as early as December of 2018. You also claimed that after that realization, you began independently developing your platform. However, in June of 2021, SEC filings, you claimed that you were still conducting development activities with these Chinese strategic partners. If you realized you needed to stop working with them in 2019, why did it take you till November to 2021 to formally terminate the agreement?
I'd have to check the exact statement, sir, but my understanding is that the investment occurs at the end of 2018, maybe early 2019, and therefore the year time period thereafter is not in 2019, in my understanding.
Okay. As you know, an alternative trading system cannot facilitate trading for unregistered securities unless they have a valid exemption. To date, how many tokens have received these exemptions, and how many of these are major tokens?
I believe a significant number of the top 50 market cap tokens have gone the exemptive route.
Okay. Mr. Chair, I see that I'm running out of time. I'll submit the remaining questions for the record, and I yield back.
Gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is recognized for 5 minutes.
Thank you. This hearing is billed as a chance to make progress on cryptocurrency, but I would like to know progress for whom? In my opinion, Congress should not be doing the work of wealthy investors in advancing toothless and feeble legislation that can make the problem of an unregulated crypto industry worse. Mr. Kaplan, can you give an estimate of approximately how many cryptocurrencies exist?
Thousands.
Okay. According to a recent Forbes article, over 22,000, and many more are bound to be created. While there are differences among them, crypto tokens do share similarities. For example, cryptocurrency generally has a low barrier to entry. If someone has a smartphone, they can simply download an app, connect a bank account, and become a crypto investor. This helps explain why cryptocurrency has become so popular, because it is so accessible. While a lot of folks want to highlight the innovation and opportunity that crypto offers, I am laser focused on making sure that the innovation and opportunity does not come at the expense of financial ruin for those who do not have MBAs or Wall Street experience or generational wealth to invest. Data shows that low-income Black and Latino adults invest in crypto at higher rates than white adults. Mr. Kaplan, for years, experts have warned of bad actors in the crypto market. Do you agree that a seemingly normal crypto investment can really be nothing more than a scam?
I think that a lot of platforms utilize the advantages of the internet with the association of innovation in order to democratize scams to the general public because they were not properly regulated and did not have proper disclosures and often had
I'll
nefarious.
reclaim my time. I'll take that as a yes.
Yes, ma'am.
Thanks. Okay. So Congress has learned important lessons on how to regulate our economy and complex investments to protect investors from scams. When regulating something as high risk and volatile as cryptocurrency, we should be comprehensive, not restrained. Public disclosure, clearly established investor rights, stringent administrative oversight are critical aspects of our securities laws, but they are overwhelmingly lacking in proposals put forth by my colleagues across the aisle. When comprehensive regulation matters, just look at the recent economic turmoil. When FTX crashed late last year, billions of dollars, not millions, not thousands, billions of dollars were lost. And earlier this year, Signature Bank, which had deep ties to the crypto industry, collapsed, putting more than $100 billion at risk. In order to protect investors in crypto, it simply does not make sense to start from scratch or create a weak regulatory system. We need to use best practices and further empower the SEC and federal watchdogs to oversee this industry. If we don't, the consequences can certainly go far beyond crypto. Mr. Kaplan, in your opinion, if there is a loophole created where non-crypto firms could take advantage of lax regulation on a secondary market to sell stock under the guise of blockchain, would they do it? Yes or no?
I anticipate they would.
All right. So if Congress is going to regulate cryptocurrency, we must make sure the solution is not worse than the problem. Thank you. I yield. She yielded. Oh, I'm sorry.
I'm sorry I didn't hear the gentlewoman yield. Thanks, the gentlewoman. And now I yield to the gentleman from Ohio, the Vice Chairman for the Digital Assets Subcommittee and the Chairman of the Housing Subcommittee, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Thank you for our witnesses, and I'm excited. It took a long time to get to this hearing. It's taken a long time to get to draft text, and I wish everyone could understand all of the legislation. We can explain it for everybody, but we can't understand it for everybody. But I appreciate that so much innovation is happening in our country. I hope we can keep some of it here and that we can get this legislation done. I've had bipartisan legislation on this subject since 2018, the Token Taxonomy Act. It's been fully bipartisan for years, and I just think how many of the calamities that people point to that have gone wrong could have been prevented or solved if we had done our job as Congress and provided legal clarity. Mr. Garrison, there's a saying, beauty's in the eye of the beholder. But should whether something's a security or not, should that be in the eye of the beholder, or should it be pretty clear to everybody, this is a security, this is not?
It should be very clear. That would provide certainty that would allow businesses to operate and investors to do so in a protected manner.
And so I think the point of a bright line test is incredibly important. And it should be clear for the investors, for the innovators. It should be clear for the regulators, too. Even Mr. Gensler can't decide whether Ether, after all this time, is a security or is not. We just had him in April in the hearings. He couldn't answer the question. So if the existing framework and existing laws are fully adequate, why can't the chairman of the SEC answer that? That'll tell you it's not clear enough. And we spent a lot of time here talking about how things could be treated as not securities. But, could it be that somebody wants to create a token that does represent a security?
Yes, and that does occur today.
Right. And so when you think about the framework that we're putting together, even if in the cases, the existing law, you could possibly find a way to do it, couldn't we create a market structure that would be more clear for everybody? How would you register a token and make it a security and be fully regulated as a security?
Absolutely. There's nothing preventing the SEC from updating the regulations to allow for tokenized equity securities or stock or bonds.
Yeah, I would add there's nothing preventing Congress from doing that either. So one of the things, too, that we talk about is the importance of self-custody. So, Dr. Shaher, you think about some of your observations that you've made. Privacy is an important protection, but when you look at people who looked at FTX, there was clear fraud. The people that had self-custody, they used the platform to be able to conduct a transaction, then they offloaded the custody of that. They were protected. So could you highlight how important self-custody is?
Absolutely. The failure of FTX was a failure not of crypto, but of traditional custodians. And the decentralized exchanges that performed much of the same functionality as FTX did not fail and in fact survived quite well through market up and downs.
Yep, thank you. So I think it's just incredibly important that we protect self-custody. My Keep Your Coins Act does that. And I hope that we can get to that kind of principle in both the stablecoin bill and the market structure bill. I want to get to stablecoins, but I think it's important to address something Mr. Himes said. So, Mr. Sexton, the commingling limitations, I don't think he actually applied correctly, because there are, in current law, due to Dodd-Frank, differences in how we treat futures versus swaps in terms of funds. You can't commingle with house funds, but you can commingle with the funds of customers. So when you think about legally separate operating commingling frameworks provided for swaps under Dodd-Frank, would you please explain how that works?
There's different frameworks with regard to asset and the protections of those assets with regard to swaps and the segregation accounts that we have in the futures world. So it's complex. It's pursuant to the CFTC's regulations, and when you have a customer seg account on the future side, generally we say that you cannot commingle the house, but the house can top that off, though, with sufficient funds to have excess funds in that seg account also, to make sure that they at all times have sufficient funds to pay off liabilities to customers.
Yeah, so I mean, that's existing law, so it's not like this is some loophole that creates some exception. It's just meant to capture the existing law and existing framework. And you know, as much as I would love to get to the stablecoin market and the importance of it, I'll have to submit some questions for the record on that. My time's expired, and I thank you all.
Gentleman's time has expired. I appreciate that. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thanks to all the witnesses who are here today. As we all know, then Chairwoman Waters led meaningful, productive, and truly bipartisan negotiations on stablecoin legislation last Congress. I would like to start by highlighting my frustration with the stripping of some very important provisions from those earlier negotiations, working against the bipartisan progress that Chairwoman Waters and other members of Congress worked on last year. With that said, I am relieved that some of the more radical proposals by my Republican colleagues were offered and were not offered and no longer in play. And I hope that this hearing can lead to a productive discussion on this very important issue. I was just discussing with the ranking member when we all got started, 3 years ago? Maybe 4. So this has been a long journey, and it's great that we're here today to really hopefully put a ribbon on the whole thing. Mr. Kaplan, I would like to begin by asking you about an issue that I've been engaged for for a long time and have some very strong concerns about. The Democratic compromise draft of the stablecoin bill includes language preserving the separation of banking and commerce, which protects from unhealthy consolidation of economic power. In simpler terms, it would prohibit non-financial commercial businesses like Facebook or Walmart from owning a payment stablecoin issuer, which would ultimately prevent massive private companies from being able to control even more of their consumers' lives. In the 116th Congress, I introduced a bill to address exactly this problem because I believe that allowing private companies to be stablecoin issuers is very dangerous. This protection, however, is notably absent from the bill that the Republicans are proposing today. Mr. Kaplan, can you please highlight the kinds of customer harm that could come from huge companies issuing their own coins? Why is this separation important?
The potential for conflicts of interest when a company has both commercial and financial interests both offered to the same customers is significant. Furthermore, the systemic risk and potential contagion risk associated with an entity that has a stablecoin is significant. There's the potential implications of a stablecoin losing its peg could have knock-on effects and contagion risks that would affect the larger financial market. And it's essential that we hold those who are issuing stablecoins to the highest standards and that we properly segregate those activities from other business activities.
Well, thank you. In carrying on with important provisions that the Republicans stripped from Chairwoman Waters' version of this bill, I would like to touch on the importance of diversity and financial inclusion in the crypto space, which this bill fails to even mention. This nation has a long history of building financial institutions and systems that are accessible and exciting for the wealthy and mostly white consumer, and inaccessible and exclusionary for everyone else. This nation continues to deal with credit inequity, lending inequity, banking inequity, and financial literacy inequity. And as clearly was pointed out by my colleague and friend from Houston, there's also panel witness inequity. And still, in front of our eyes, it appears that we are repeating our mistakes of the past and building a financial system that only makes the rich and privileged richer and more privileged. So, Mr. Kaplan, can you please speak about the importance of building financial inclusion language into regulatory legislation?
It is essential for any industry to make sure that it is able to be afforded and available to all segments of society. And as such, it's important that there is diversity and inclusion.
So can you give us an example of what you think we need to add to make sure that that happens with within this legislation?
I don't have a specific example off the top of my head. I think that it is essential that there is a mention such that the policy of diversity and inclusion is made sure to be understood and integrated into the crypto industry and the larger financial industry as a whole.
Thank you. How can crypto-based companies work to better include low-income and minority communities in the crypto space? How can they best reap the benefits of functional, well-regulated crypto industry that we are all striving for? Again, Mr. Kaplan.
What we saw with FTX and the like was that they used the internet under the guise of innovation and a speculative new investment instrument in order to basically allow the general public and certain segments of society.
Gentlewoman's time has expired. Gentlemen, I recommend the witness continue his answer in writing. Turn to the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you, Chairman, and thanks to our witnesses for taking the time to be with us today. I want to dive right in. The Democratic talking point that Gensler's approval of this one special purpose broker-dealer license does not mean that the current system is working. Why? Because an ATS cannot facilitate trading for any unregistered securities not offered under a valid exemption. Additionally, Gensler and the Democrats, and apparently Mr. Kaplan, allege that nearly all tokens are unregistered securities, so this approval does nothing for retail investors and the general public. Mr. Garrison, isn't it correct that there currently aren't any registered digital asset securities with real customer demand and liquidity? For example, can an ATS offer Solana or Cardano, which the SEC has recently alleged are unregistered securities, to retail, non-accredited investors on its ATS today?
No, they cannot.
And Mr. Garrison, would the outcome be different under the market structure legislation that we have coming forward?
Yes, so the legislation would allow an ATS to list and trade restricted digital assets alongside payment stablecoins, alongside digital commodities. Each of those would be regulated under different regimes, but an ATS regulated by the SEC would allow all those products to trade.
Thank you. Mr. Garrison, can an ATS currently offer both digital asset securities and digital asset commodities alongside each other on the same platform for retail trading?
No, they cannot.
And would the outcome be different under the market structure legislation?
Yes, it would be.
Thank you. Mr. Garrison, Prometheum has been approved to custody digital assets under a special purpose broker-dealer framework that the SEC issued in 2020. Under current law, digital assets may be classified as securities or commodities. Can a special purpose broker-dealer custody both digital asset securities and digital asset commodities on behalf of retail investors?
No.
So, Mr. Garrison, given this fact, what impact, if any, does the SEC's approval of this special purpose broker-dealer license have on retail traders?
Not a significant impact.
And Mr. Garrison, the SEC has indicated that they expect digital assets to be registered by a promoter or, quote, a promoter, sponsor, or other third party, close quote, that, open quote, provides essential managerial efforts that affect the success of the enterprise, close quote. The problem is that certain digital assets are open source, peer-to-peer digital currencies that are transferred through a decentralized public ledger that is maintained by a network of computers operated by individuals who, apart from possibly transferring digital assets to one another at some point in their lives, may never interact. Take Dogecoin. Mr. Garrison, who exactly is the SEC expecting would come in and register Dogecoin?
I do not know.
Mr. Garrison, in 2021, SEC Chair Gensler said regarding the regulation of digital assets, quote, there are some gaps in this space. We need additional congressional authorities to prevent transactions, products, and platforms from falling between regulatory cracks, close quote. He now says the securities laws are clear that he doesn't need additional authority from Congress. Mr. Garrison, do you agree with Chair Gensler version 1, who we might call Dr. Jekyll, that he needs more authority from Congress to regulate crypto? Or do you agree with Chair Gensler version 2, Mr. Hyde, that the federal security laws are 100% clear and no relief is necessary to regulate digital asset securities and crypto platforms seeking to support them?
I'm not sure that I agree with either version. I believe the SEC has authority to regulate digital assets that are sold pursuant to investment contracts in a clearer way than they have. But I do also disagree that the securities law's application to the sale of digital assets is certainly not clear.
And shifting gears, Mr. Allaire, given the Federal Reserve's incompetence during the most recent turmoil in the banking sector, are you confident that they will be able to regulate stablecoin issuers under this bill?
Thank you for the question, Congressman Rose. I believe that the bill does a very good job of very clearly establishing the core standards that are important for a stablecoin to function. And so I believe Congress is doing its job in identifying that.
Gentleman's time has expired.
Thank you. I yield back.
The chair recognizes the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Before we get to the substantive question of what to do with crypto, we as a country have to answer a more fundamental question. Who among us should get to decide the future of emerging technologies like crypto and blockchain? Should it be Chair Gary Gensler, an unelected bureaucrat who answers only to himself? Or should it be the United States Congress, whose members are elected by and therefore accountable to the people? And so, Mr. Allaire, do you believe, as I do, that an act of Congress would be the most democratic means by which to decide the future of digital assets?
Thank you for the question, Congressman Torres. I do agree, and in fact, the Presidential Working Group specifically asked Congress to act urgently on this matter over a year and a half ago. And so I believe it's critical that Congress does take ball control here.
You know, there are crypto companies like Circle that strive to be compliant with the law, and then there are crypto companies that seem intent on willfully evading the law. And yet Mr. Gensler appears to see no difference at all between the two. He treats them all as one and the same. His enforcement has been indiscriminate in nature, which brings me to the lawsuit against Coinbase. Mr. Garrison, if the SEC sincerely thought that Coinbase was operating an unregistered securities exchange, then why on earth would the SEC approve Coinbase as a public company? Or why would the SEC not at a minimum require Coinbase to disclose its status as an unregistered securities exchange as a material risk to the investing public? Do you see a contradiction between the SEC's 2021 approval of Coinbase as a public company and the 2023 enforcement action against Coinbase?
I do see a contradiction. As part of the filing review process, taking a filing effective under the securities rules requires a public interest finding. Typically, a public interest finding, it's a very loosely defined term, but you might argue that a act by the company that is inconsistent with securities laws, what might be not in the public interest.
And I want to interject, the SEC made the following statement in the Coinbase lawsuit. It said, declaring effective a Form S-1 registration statement does not constitute an SEC staff opinion on or an endorsement of the legality of an issuer's underlying business. So when it comes to S-1 registration, the SEC is asserting that it has no opinion on whether an issuer is complying with the very laws that the SEC is charged with enforcing. That strikes me as strange. It's almost as if, suppose the SEC would approve the mafia as a public company and then say, but we have no opinion on the underlying legality of the business. As a layperson, that just strikes me as absurd. So am I missing something, or?
No, I think that's where the public interest finding comes in, and I think perhaps the other side of that coin is that—
No pun intended, right?
Yes, is that you don't want the SEC to take responsibility for what is in any filing, which is, I think, what's getting at, some of that language is getting at as well.
In an interview with the New York Magazine, Chair Gensler said that everything but Bitcoin is a security. Of the more than 200 listings on the Coinbase exchange, the SEC lawsuit only identifies 13 as unregistered securities. 13 out of more than 200 seems to contradict the Gensler doctrine that everything but Bitcoin is a security. Do you see a contradiction there?
Yes. It would be nice to have clearer insights into what tokens, what digital assets the SEC believes are securities instead of seeing them piecemeal through enforcement actions.
The digital market structure discussion draft provides for a safe harbor, and I see the need for a safe harbor that protects good faith crypto companies from arbitrary and capricious enforcement actions. But what about bad faith crypto companies? How do we prevent bad faith crypto companies from exploiting the safe harbor to prevent legitimate enforcement actions?
So included in the market structure bill are the typical anti-fraud protections that exist in both the securities and commodities laws. So whether a digital asset is sold through the new SEC exemption, the SEC's robust anti-fraud authority would also apply there. And on the CFTC side, if a digital commodity was sold or manipulated in a fraudulent way, the anti-fraud provisions of the CEA would apply as well.
And then a quick question about the applicability of securities law to secondary market transactions. Has there ever been a single statute or a single rule or regulation or a single court case that expressly affirms that the Howey test applies to secondary market transactions?
No.
Are you sure?
To the best of my knowledge, yes.
Are you positive? Okay.
Gentlemen's
My time has expired.
As you can see, there's a vote on the House floor. It's the chair's intention to continue until there are approximately 200 on the non-voting screen. We'll then recess and reconvene immediately after votes. I now recognize the gentleman from South Carolina, Mr. Timmons, for 5 minutes.
Thank you, Mr. Chairman. Mr. Garrison, getting back to the exemption that Congresswoman Wagner covered earlier, the new exemption in the bill allows participation of non-accredited investors in primary issuances of digital assets. You started talking about the protections that the market structure bill provides for retail investors in primary offerings. The exemption, as I read it, provides that a non-accredited investor is permitted to, over a 12-month period, purchase digital assets issued in a primary sale that equal 5% of the person's net worth or 5% of their annual income. Rough math for a person with $990,000 of net worth or $190,000 in annual income would be $49,000 or $9,500 of annual investment, depending which is greater. So my question is, in your view, is the exemption as laid out in the discussion draft a good balance of retail investor access to this new asset class and traditional consumer protections?
I believe it is a good balance. Personally, I'm opposed to individual limitations on investments generally, but I recognize others, reasonable people can disagree on that. And I think this approach in the market structure bill really borrows from regulation crowdfunding, which has these individual investor limits, as does Regulation A. And I think that has proven to be a protection that can be valuable in these exemptions.
Thank you for that. A common way for a project to distribute digital assets to its users is through broad distributions in order to support the development of its network. Mr. Garrison, again, how does this proposed legislation treat digital assets distributed in this manner, and why does this treatment more accurately correspond to how the digital asset markets operate?
Sure. So the market structure bill acknowledges that some digital assets are created through the normal functioning of the network itself, whether that's through a validating transaction or staking or anything like that. And that it just makes clear that the securities laws are not needed to protect those activities. Those activities are separate. They're not securities transactions. And so it more clearly separates the transactions that are in need of consumer investor protections from those that are not in need.
Thank you for that. Mr. Garrison, again, in the proposed legislation, there are tests for decentralization and functionality of the blockchain network. Would you share your views on this construct in the legislation?
Yeah, so I think this is a really great first effort in trying to put a construct around how decentralization can occur. It's an issue that has really been difficult for those in the industry to come to terms with because there's no third-party standard setter that we can look to say this is how networks are decentralized. So, for example, when I worked for Commissioner Peirce and she created her token safe harbor proposals, there were a lot of ideas in there of how do you show decentralization, and a lot of different ideas came to the foreground. Some of them include looking at the ownership of the tokens of the network. Are they concentrated in any one particular group or not? Another is just the functionality of the network. Who is contributing to the code? I think in the early days of a lot of networks, you see some key contributors that are responsible or perhaps have a key that they can write and change code as needed on an emergency basis. Over time, those things typically go away. Those are good indicators of decentralization. What are the number of participants in the network, both end users, validators, miners, whatever the protocol may be? I mean, there are a lot of different factors you can consider, and I think this bill does a good job of really drilling down and saying what are the key ones that matter, and it's really keeps coming back to this idea of unilateral control. Does a person or a group of persons have control over this network?
Thank you. One last question, Mr. Garrison. Some have alleged that the proposed legislation creates light touch regulation for digital assets. However, the bill seeks to apply the same rules for current SEC and CFTC registered intermediaries with adjustments as needed for the unique characteristics of digital assets. In some instances, the requirements of digital asset firms are more onerous than traditional intermediaries. So would you discuss how the bill applies equal or stronger standards to digital asset firms?
So the bill brings digital assets into the SEC and CFTC regulated universes. Currently, digital asset transactions are not covered here. So both the SEC would oversee in the initial issuance in certain situations through the new exemption, and the SEC would also oversee secondary trading through an ATS. Normal securities trade through ATSs, so all of the protections from an ATS would also apply here in the ATS.
Thank you for that. Mr. Chairman, I yield back.
Gentleman yields back. It's a pleasure to recognize the gentleman from Illinois, Dr. Foster, for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. So I'd like to start with what I consider the two foundational questions in this that are not, I don't believe, really addressed in this draft. The first one is the answer to the simple question: if we wish to prevent ransomware and all kinds of illicit activities, is there any way to do that if we allow self-custody of assets? Or is it pretty much a binary thing? Either we're going to allow self-custody and live in a world with ransomware and so on, or not. Is there any alternative to that, third path?
Congressman, it is entirely possible to control these systems at the ingress and egress points. So it's entirely possible to preserve self-custody and all the benefits that come within.
But how does that work, actually? If you go and take your dollars and you put them into the systems you're developing, then they go off and become self-custody. They're used for human trafficking or you name it, ransomware, you name it, and then someone comes back after having passed this through anonymous currencies that are better than Bitcoin for avoiding, truly anonymous alternatives that are being developed and actually exist to some degree today. And then they pass it through these anonymizing techniques, and then they present us something that has been self-custodied to your system. It seems like you're just the last leg in a complicated money laundering scheme. And tell me why that's not really technically the case?
That's technically not the case because the sets of tools we have for tracking and tracing money flows are incredibly sophisticated. Chainalysis and TRM type companies are quite able to trace even those anonymizing transactions and trace the flow of funds. If you look at the recoveries that law enforcement has done in recent years with the aid of these increasing tools.
Oh, yeah, but these are Bitcoin type things that they're tracking late. You rapidly get into classified discussions and briefings that I've had on this. But a bunch of smart people are working very hard and effectively to really make these anonymous. I think they're more likely to succeed than the mouse is likely to not survive the cat in this case. But anyway, so that I don't think that today you can guarantee that that won't be the case. And so I think that's the first thing, and we should continue this technical discussion offline. The second thing is that if we wish to prevent market abuses, things like front running or wash trades, there are estimates that more than half of all Bitcoin transactions are actually wash trades, for example. If we wish to prevent that, is there any alternative to having some regulator somewhere that sees the true identity behind the participants on both sides of every trade? How do you prevent wash trades if there is not such a regulator somewhere? And Mr. Sexton, I'm very much an admirer of how this has been handled with the trader ID mechanism.
It has, and it's key that if you're going to prevent those types of trading abuses, that you have to know who is on both sides of a trade.
A trusted regulator must be able to see who's on both sides of the trade.
Correct.
Correct. You don't need, the traders don't need to know who's on the other side. In fact, it's not good for them to know on the other side who's on the other side in the typical instance. But when you see something that looks abusive, you have to go and first off know who the people are, and you also have to make sure that the trader ID is, for example, biometrically deduped, so you don't have one person operating multiple trader IDs. That's a major no-no in your industry.
If you bring this into a regulated environment under the NFA and the CFTC, intermediaries need to know who their customers are, and if you have exchanges or trading platforms, they need to know who is going to be on the opposite side of those trades. That is the bedrock of the regulated environment that we have today under the CFTC.
Yeah, but if you have, for example, the ability to make derivative bets and have a spot market over here, a regulator has to see both the spot market participants, the true IDs of both the spot market participants and everyone who's making derivative bets on the basis of those spot prices. That's also, it seems like, this is something that spans the current jurisdictions of the SEC and CFTC.
You have to have cooperation between regulators so that they know what a market user is doing in both the spot markets and in the futures markets.
Right, and this actually has to work internationally if you're talking about crypto assets that are traded internationally as well. So it's an even more complicated thing. You've got some sort of solution internationally in the options market. Anyway.
There is international cooperation is also essential.
The gentleman's time has expired. The witness can provide additional comments in written testimony. I'm not to recognize myself for the 5 minutes for the purpose of asking questions. Mr. Garrison, I want to follow up on Congressman Emmer's comments earlier. According to the SEC Commissioner Hester Peirce, a digital asset may be offered and sold initially as a security because it's wrapped in a transaction involving an investment contract, but the asset may later be emphasized and sold outside of an investment contract. I think it's a key point as we think about how our legislation should categorize different types of digital assets, regardless of their classification when first issued. Can you elaborate on this principle and then comment on how the proposed legislation addresses this?
So a digital asset, when it is sold pursuant to an investment contract, the digital asset itself does not constitute the security. Under the Howey test and 77 years of case law, courts have come up with an analysis to determine when a transaction, contract, or scheme may be sold in a manner that is in fact a securities transaction. This is very different than the test for what is an equity security, what is a stock, what is a bond. And the case law makes it quite clear that the object of the investment contract, whether it be the orange groves in the original Howie case, or there's some fun exotic cases about chinchillas and whiskey receipts, the chinchillas themselves are not securities. And so applying that logic to the digital asset space, the distinction becomes even more important as one learns more about digital assets and understands why one holds a digital asset to operate or to function and participate on a network. And once those functionalities are realized for the digital asset, well, you start to realize that there's no actual central party that maybe was making promises at the time of the initial sale for fundraising, but later in time, a fully decentralized functioning network, there is no central party. There is no one that would be the equivalent of an issuer in a securities offering.
Thank you for providing that distinction. Let me shift gears to you, if I can, Mr. Kaplan. There's a little bit of confusion around the circumstances and disclosures associated with Prometheum, their filings for the alternative trading system and special purpose broker-dealers. In your testimony, you noted that you terminated all co-development work and strategic relationships with your Chinese affiliate in late 2021. When did Prometheum take full control of the product development?
Prometheum realized that its endeavors with Wangzhang were not going to bear fruit, and as such, basically, that in conjunction with the ongoing decoupling that was occurring in the larger geopolitical sphere led to the decision to terminate that relationship. I believe the termination agreement is October 2021.
October 2021, thank you. Did the SEC or FINRA at any point raise concern about the relationship between Prometheum and the Chinese firm?
We had both a CFIUS inquiry and an SEC investigation where we were required to submit all communications with any foreign entity for review to the SEC. And basically the SEC, after we were told by our SEC counsel, after a period of time, closed the investigation.
Thank you. Has Prometheum ever had to adjust its policies or procedures at the request of HashKey or representatives of the Chinese government?
No.
Okay, I appreciate your testimony there. I want to just echo the concerns raised by some of my colleagues. Our regulators have done everything in their power to push digital asset business overseas, but they seem to be quite comfortable giving a stamp of approval to a firm with the relationships back to China. To me, this underscores the need for clarity and consistent regulation in the industry structure. Cognizant of my time, I'm going to come back to you if I can, Mr. Garrison, just for a second. Mr. Rose brought this up a little bit, but I think it's worth hitting the point home before we go into recess. There's been some hyperbole in particular about how the bill is described. Does the modifications upend securities law, as some have suggested?
No, it does not. It borrows from existing provisions of securities laws.
Okay, I got 40 seconds. I'm going to jump back to Mr. Allaire. Stablecoin legislation attached to this gives the Fed a backstop authority over state-chartered payment stablecoin issuers. Can you describe why the backstop is important and what the Fed can and can't do with it?
Thank you for the question, Congressman Steele. I think it's critical. I think the first is really the fundamental standards around what can be in reserves, the reporting and disclosure requirements, the need to separate these assets. Those are part of that kind of federal framework. Additionally, setting standards under Section 4 around capital adequacy, risk management, safety and soundness, and others, they can obviously also enforce against those.
Thank you. Cognizant of the time, and cognizant that we are now under 200 votes, pursuant to the chair's previous announcement, the committee will stand in recess until the conclusion of votes.
The committee will come to order. The committee recognizes Mr. Nickel for 5 minutes.
Thank you so much to our chair and ranking members. Thank you so much, Congressman Flood, as well, for being here today. And thank you to our witnesses. I know it's been quite a long day, so thanks for joining us. I'm happy with the progress our committee is making on stablecoin legislation. The most recent draft includes many of my suggestions, like protecting state regulators, adding consumer protections, and ensuring banks can safely hold digital assets in their custody. I hope that we can all come together, put politics aside, and reach a bipartisan agreement on this legislation. Not only is passing a stablecoin bill essential to protecting consumers and encouraging innovation, but it's also vital to providing much-needed regulatory clarity. The SEC's regulation by enforcement, which we've seen ramp up in the last week, is only going to send digital asset companies offshore to places like the Bahamas, where Americans will have no protections. Additionally, as I've said before, stablecoin legislation can reinforce the dominance of the US dollar as the global reserve currency, all while making it stronger, more accessible, and more competitive. Mr. Allaire, first question to you. Can you please describe the privilege the US is afforded because the dollar is the dominant global reserve currency?
Thank you for the question, Congressman Nickel. As is often referenced, the dollar presents the United States with an exorbitant privilege, and that is in many forms. I think that privilege is around low borrowing costs for the government, for households, for businesses. I think strong preference in commerce and trade internationally, which helps grow opportunities for people and businesses here, as well as the execution of soft power around the world. And in an environment today where that's being challenged, it's more important than ever that the U.S. Take every effort to strengthen dollar competitiveness, and I would agree with you that the stablecoin bill is a significant step towards increasing dollar competitiveness.
Thanks so much. And in your testimony, you said, quote, currency competition is real and is increasingly defined by technological competition. Perhaps no nation understands this better than China, end quote. Mr. Allaire, as we're designing stablecoin legislation, how should we think about currency competition? Would the most recent draft of the stablecoin bill ensure that the U.S. dollar remains competitive, safe, and accessible?
I think it would be a huge step forward in that. The United States competes with highly competitive technology companies, financial companies, and open, free, and fair markets in a rules-based system. That has served us incredibly well in the development of the internet. It has served us incredibly well in the realm of payment technology innovation. And I think an innovation like stablecoins, it can also be the leader globally. Critically, stablecoin legislation, as currently submitted to the committee, does in fact create, I believe, the safest digital dollar in the world. It creates a mechanism to ensure that there's a competitive market for the issuance of that by banks and non-banks, and that those firms can compete in that technological competition with constantly upgradable blockchain infrastructure and be competing with state-driven actors such as China.
Thanks so much. Mr. Garrison, moving on to you. I'd like to talk about the majority's market structure bill, which I'm still reviewing. I'm encouraged to see that we're making progress, but I do have some concerns with this current version of the bill, which I understand is just a starting point. Whether you love crypto or hate crypto, you should support market structure legislation. This would safeguard consumers while updating our security laws to work with modern technological innovations. And frankly, burying our heads in the sand just is not an option here. Mr. Garrison, can you please explain the dangers of congressional inaction on digital asset market structure? Specifically, how would consumers be harmed without clear regulations that encourages companies to remain here in the United States?
So if the status quo were to continue, I think it would harm investors and consumers. It harms the participants in the digital asset ecosystem, and it ends up harming the U.S. economy. There is a lack of a federal regulator over the spot markets for digital assets right now as we speak. So anyone trading on a digital asset platform in the U.S. is at the mercy of the platform's own controls and procedures and processes and compliance with other laws.
Gentleman's
outside of the
time has
securities.
expired.
You yield back.
Thank you, Mr. Nickel. I now recognize myself for 5 minutes. I'd like to start by to read a question from a comment letter that Prometheum sent in response to the SEC's December 2020 Special Purpose Broker-Dealer Framework. Quote, "The definition of a digital asset security as used in the proposal is a digital asset that meets the definition of a security under the federal securities laws. This definition puts a burden on the industry to determine which digital assets are securities. As a result, we believe the clarity is needed to understand the regulatory framework they must comply with," end quote. That was in a letter dated April 26 from Prometheum, specifically signed by Benjamin S. Kaplan, co-CEO of the company. I offer this into the record without objection. This concern, which Prometheum themselves raised in 2020, probably sounds familiar for those who track this committee closely. It is the exact same concern we've heard from witnesses in front of this committee before. How can a broker-dealer register if they don't know which assets are a security and which are not? Further, it makes the same argument that other firms have made, that the lack of clarity from the SEC puts an undue burden on the industry. Mr. Kaplan, in your testimony, you were very confident that no new legislation is needed in the digital asset space to clarify this question. What has changed between the date of this letter in 2021 and when your firm called for clarity, and now? What has changed?
Over the 2+ years since that time, there's been additional enforcement actions and statement by the SECs which have clarified any questions that we had in regards to the designation of a digital asset as a security.
Mr. Kaplan, Prometheum's website says that Prometheum ATS supports, quote, "many tokens that mostly trade on crypto exchanges," end quote. I'd like to dig in on that just a little bit. Can Prometheum customers trade in Ether? If your answer is yes, please explain how.
Not currently.
Can Prometheum customers trade in Bitcoin? If your answer is yes, please explain how.
No.
Just for the audience at home's benefit, Ether and Bitcoin make up more than 60% of the digital asset market. Mr. Kaplan, given that either Ether and Bitcoin make up more than 60% of the digital asset market, if the current system is working, why can't your customers trade the most popular and widely used digital assets?
Regulation and new ATSs and custodians should take a crawl, walk, run approach, and essentially they will proceed to add additional assets and abilities as time goes on. I'd like to point out when the...
I'm going to reclaim my time. Mr. Kaplan, did Prometheum receive any additional exemptive relief from the SEC that has not been publicly shared?
No.
Thank you, Mr. Kaplan. Prometheum's special purpose broker-dealer license does not address the core issue. There is not a consistent definition of a digital asset security within current law. This point was made obvious when Chair Gensler could not say definitively whether Ether is a digital asset security when asked by Chairman McHenry in this very room a couple months ago. In other words, that same question that Prometheum themselves raised in their 2021 comment letter is still unanswered. That's why legislation is needed. That's the problem that the chairman's bill works to solve. To testify in front of our committee that your company's charter, which only allows for trading in a very small subset of assets, is evidence that no legislation is needed, just doesn't make sense. If anything, the fact that Prometheum's customers cannot trade some of the most popular digital assets is an illustration of the broader problem, Mr. Kaplan. I yield back. With that, the gentleman from Iowa, Mr. Nunn, is recognized for 5 minutes.
Thank you, Mr. Chair, and I think we are well said on the role of having clarity in this space, which is what Chairman McHenry is aiming to do. I want to thank the Chair's comments here, and last week I sit on a second committee. It's called the Ag Committee, and it has oversight on digital assets. I had the pleasure of talking with the CFTC Chair, Binham, on his thoughts on market structure and what we're discussing today. His thoughts on this legislation was that a much-needed change is in order to give clarity to the digital asset ecosystem. Right before CFTC Chairman Binham testified, however, we saw his counterpart, SEC Chair Gary Gensler, charge Coinbase with listing digital tokens he deemed to be securities. Chair Gensler went so far as to say that we don't need more digital currency. We already have digital currency. To quote, it's called the US dollar, it's called the euro, it's called the yen, end quote. So let's make one thing very clear that the rest of the world is already attuned to. Chair Gensler's blockchain innovation and technology is here to stay. It's thriving, and the US market needs to be able to appreciate it. This lack of consensus among our federal regulators, however, on the appropriate regulatory treatment of digital assets is what we need to discover and why we're here today. The inconsistent treatment by federal regulators underscores the urgent need for Congress to pave clear rules of the road for both market participants and investors. If Congress does not act and lets federal agencies to continue to engage in territorial disputes and empire building, this will have a grave national concern, both for our trade as well as for our national security. From this sentiment, Europe, the UK, Singapore have all marched out as leaders in this space. They've worked effectively within their jurisdiction. In fact, MiCA is real. Venture capital investment in Europe in crypto projects are up to 1,000% in 1 year alone. Investment that could have been happening in US markets. To my home state of Iowa, these represent real tangibles. They're American jobs, they're future investment. To America, it means innovation that is fleeing offshore. That is why this legislation that the chairman has brought forward, I believe, is highly important. So, Mr. Garrison, your former boss, the SEC Commissioner, Hester Peirce, explained how a digital asset may be offered as a sold initial security based on the initial transaction it's offered in, but the digital asset may later be offered outside this investment contract. You spoke with my colleague here earlier today. Highlight specifically how this proposed legislation would address that.
So the market structure bill would address that by providing a clear exemption for issuers that would like to sell a digital asset pursuant to an investment contract. So if you want to build a network and sell the digital asset that is required for the network, this bill would allow an exempt transaction for up to $75 million within a 12-month period. It would allow for individual investment limitations for non-accredited investors to purchase in. There would be robust disclosure requirements. The disclosure requirements would be tailored to the needs of token purchasers, of digital asset purchasers. And it would place restrictions around activities that people want to engage in the US but currently cannot.
So this would provide a clear framework. Absent this legislation, we would be like Coinbase and have to come to Chairman Gensler on a come and register approach, meaning that everyone would have no clear guidance but would have to go and have a sniff test done by the SEC, which at this point has been only punishing, no carrot, no incentive, no guidance. Is that correct?
Yes.
Mr. Sexton, the proposed legislation that we've been discussing imposes significant consumer protections. Requirements that all digital commodities intermediaries register with the CFTC would have to be met, most notably the segregation of customer assets. What are your thoughts on a customer protections provided for in this legislation?
For your question, the customer protections provided in this proposed legislation mirror the customer protections that have been in place for years with regard to the regulated futures markets. Customer assets, capital, disclosures, Congressman, you can go down the list within the bill, but those have been in place for years.
Would the NFA have the ability to implement these new standards with the CFTC?
We totally have that ability to work with the CFTC to do so.
So for the consumer, for the process, for the providers, and for the national security of the United States, this legislation makes very good sense.
Gentleman's time has
Mr.
expired.
Chair, I yield my time.
Gentleman yields back. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
I want to thank each of you for your testimony and for a long day, so I'll be brief. Mr. Kaplan, in your testimony, you state that, quote, Prometheum provides Americans participating in the crypto Web3 space with the investor protections of the federal securities law. What assets do you plan to offer?
Digital asset securities.
But you've got a limited offering on that, don't you?
I believe that a certain number of the top tokens qualify as digital asset securities.
What percentage?
30, 40?
But to be,
Possibly a lot more. And as Chairman Gensler has said, the overwhelming majority of digital assets, arguably everything besides for Bitcoin, is potentially a security.
but you would have, pick a 60% that would be not regulated under the.
Those numbers are guesses at best. I'd have to look into it more deeply. It's my belief that almost every smart contract-based network token was issued with the intention to raise capital from the general public, with the intention of the investor to make money in the common enterprise from the efforts of that common enterprise.
I get that. I guess you claim that you're providing investor protections really would not be all-inclusive at all. Now, with your company, what bothers me about Prometheum is the Chinese 25% ownership. Is that, I think I heard from another, when you were questioned by another congressman, there's no Chinese investor with 25% that sits on your board, is that right?
There is no Chinese investor in our company that has 25%, sir. I said 20%.
So they have 20%?
Correct.
Currently?
Correct.
Is that not a problem for this country to open up this type of the information that you would be given? It shocked me FINRA and SEC approved this.
Prometheum went through a series of SEC inquiries and CFIUS investigations. We changed our bylaws. We terminated any agreement. There is no code, nothing done from China that is involved in Prometheum in any capacity.
But they sit on your board with a vote that owns 20%.
Sir, I believe there's many Chinese who sits on boards of certain companies in
I'm
America.
talking about Prometheum. They just got approval from the SEC and from FINRA.
And there was a full examination by CFIUS into our interactions, plus the SEC, who we had to send all communications with China to any foreign investor. So essentially, they examined everything we had previously done, and based on their examination, they thought it was okay. They closed that investigation.
Well, okay. Well, I doubt your claim is true that you make that it's covered under the. You're given. That wouldn't qualify for protection for the federal securities law that you're offering with this type of investment group. Mr. Garrison, you're, I think, an SEC alum?
Yes.
Are you aware of the bicameral bill that Tom Tillotson has, and I think it's Senator Gillibrand, that prohibit Chinese entities from acquiring U.S. digital asset companies? You worked at the SEC. What is your opinion of this bill?
So I am not familiar with that exact bill.
It stops Chinese companies from investing in Prometheum.
I believe the national security concerns should be taken into account in any digital asset legislation and regulation.
So do you agree with the bill or not? Do you think, is that something you would?
Yeah, I mean, in general, broad terms, again, I have not read the bill, but yes, that.
Okay, it just prohibits Chinese fund.
Yeah.
You know, if we don't realize now, and my time's about up, we don't realize now what China's doing to this country, and the information that's divulged being on a board of the size of this company, and the private information for a company that is pretty much overtaking this country or attempting to. I think it's a sad day in this country that this is what's happening, and the protections are not there, and you basically know it. I yield back.
I'd like to thank all of our witnesses for being here and their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I will ask our witnesses to please respond no later than July 10th, 2023. This hearing is adjourned.
There it is.